In 1997, investors basked in the glow of a booming bull market, and Warren Buffett's strategy was a beacon of steadiness amid the frenzy. Buffett's strategy Part 1 catered to those heady days when tech stocks soared, optimism reigned, and traditional value investing seemed quaint to some. Yet, as we fast forward 4 years, the landscape is unrecognizable. The once dominant tech sector has crumbled under its own weight, leaving investors scrambling to salvage what they can. Blue-chip stocks, those steady, reliable stalwarts, have become a refuge for the battered and disillusioned. It's in these turbulent times, as markets tumble from dizzying peaks to sobering troughs, that investors wonder, are there any constants in this chaos? The answer is a resounding yes. Warren Buffett's value investing strategies remain a compass for navigating uncertainty. And now, in the wake of this bear market, comes Buffett's strategy Part 2, a timely guide that not only reaffirms the enduring power of Buffett's principles, but also teaches how to thrive in a downturn. The genius of Buffett in a bear market. Buffett's strategy Part 2 focuses on a truth that many investors overlook. Bear markets are not just times to survive, they're times to thrive. Buffett's own career is proof. His ability to exploit undervalued stocks during downturns has made him the world's second richest person, even as others falter. While the market panics, Buffett sees opportunity, guided by his unwavering principles and sharp analytical tools. This guide takes readers by the hand and walks them through the same methodologies Buffett himself uses. From deciphering financial statements to understanding intrinsic value, readers will learn to identify stocks that are not only undervalued, but also possess the strength to deliver outsized returns over the long term. The key? Buffett's focus on fundamentals, companies with strong earnings potential, durable competitive advantages, and management teams he can trust. The Buffett Playbook, Lessons from Real Investments, Buffett's Strategy Part 2, delves deeply into Buffett's recent moves, illustrating how his strategies translate into real-world success. For example, during the post-dot-com crash, while many fled the markets, Buffett saw gold in the rubble. His investments during these turbulent years yielded substantial profits, not through speculation, but through careful, calculated bets grounded in data and discipline. One standout theme is Buffett's aversion to risk. While his returns are legendary, his capital preservation strategies are equally impressive. Unlike those who gamble on volatile market trends, Buffett operates with almost zero risk to his principal. This guide reveals how he does it, using formulas and equations that strip away the noise and focus on what truly matters: value. Why bear markets are Buffett's playground. As readers progress through Buffett's Strategy Part 2, they'll come to understand why bear markets are a gift to those who follow Buffett's philosophy. When prices drop, great companies go on sale. For the patient, disciplined investor, these moments present opportunities to acquire valuable assets at a fraction of their true worth. Buffett has famously said, "Be fearful when others are greedy, and greedy when others are fearful." This guide teaches how to internalize and act on that wisdom, even when fear dominates the headlines. A call to action, Buffett's Strategy Part 2 isn't just a book, it's a roadmap for investors ready to embrace the opportunities that downturns offer. It challenges readers to think differently, to focus on value rather than hype, and to see market dips not as threats, but as openings. For those willing to learn and apply these principles, the rewards can be transformative. As we stand in the shadow of a fallen bull market, the lessons of Warren Buffett are more relevant than ever. His strategies are not about chasing trends, but about understanding the timeless principles of investing. And as Buffett himself would likely tell you, there is no better time to start than now. The Quiet Genius, Lessons from Warren Buffett's Journey. In the vast tapestry of financial legends, one name stands unrivaled: Warren Buffett. Known as the Oracle of Omaha, he transformed a modest stake of $105,000 into a staggering $30 billion fortune, all through disciplined stock market investing. His story is not just one of numbers, but of grit, ingenuity, and lessons that resonate far beyond the balance sheet. A childhood rooted in the Great Depression. Buffett's beginnings were deeply influenced by history. Born during the 1929 stock market crash, his early years were shaped by financial scarcity. This economic backdrop sowed the seeds of an obsession, understanding, saving, and growing money. As a child, Warren's fascination with money was unmistakable. His favorite toy was a money changer, a precursor to the financial maneuvers he'd master later. By 6, he was buying and selling Coca-Cola for a profit, and by his teens, he had accumulated $6,000 through ventures like newspaper delivery and a pinball business. His entrepreneurial instincts were razor-sharp, fueled by books like 1,000 Ways to Make $1,000, which he practically memorized. At the defining moment, meeting Benjamin Graham, Warren's hunger for knowledge led him to Columbia Business School, where he encountered Benjamin Graham, the father of value investing. Graham's teachings were a revelation. He introduced Warren to the concept of buying undervalued stocks, companies worth more than their current market price. This principle became the cornerstone of Buffett's investing philosophy. The relationship was transformative. Graham became Buffett's mentor, and though Graham initially declined Warren's offer to work for free, persistence won. Warren joined Graham's investment firm, absorbing every nuance of value investing. The birth of Buffett Partnership. After Graham retired, Warren returned to Omaha, eager to carve his own path. With relentless determination, he persuaded 8 investors to pool $105,000. Thus, in 1956, the Buffett Partnership was born. Over 13 years, the partnership delivered a staggering 30% annual return, cementing Warren's reputation as an investment prodigy. His mantra was simple but profound: invest your money as you would your own. True to his word, Warren had all his personal wealth tied up in the partnership. From partnership to empire, Berkshire Hathaway. In 1969, the market's frothy valuation prompted a bold decision. Warren dissolved the Buffett Partnership, returning funds to investors. However, one asset remained: Berkshire Hathaway, a struggling textile company that Warren had acquired. Using its resources, Buffett pivoted into insurance, recognizing the immense potential of investment floats, the premiums insurers hold before paying claims. This move was genius. By leveraging Berkshire's insurance operations, Buffett created a tax-efficient engine to fuel his investments. Over the decades, this strategy transformed Berkshire from a failing textile business into a global conglomerate, with its stock price soaring from $19,000 to over $40,000 per share. The hallmarks of Buffett's legacy. Warren Buffett's success is rooted in timeless principles. 1. Value over hype. He buys businesses or stocks that are fundamentally sound, even if they are out of favor. 2. Skin in the game. Warren always invests his own money alongside his partners, ensuring alignment of interests. 3. Long-term thinking. Rather than chasing short-term trends, he seeks sustainable growth over decades. 4. Adaptability. His pivot from textiles to insurance exemplifies the ability to adapt to new opportunities. The private billionaire. Despite his wealth, Buffett remains remarkably humble. He lives in the same modest home he purchased in 1958 and famously enjoys simple pleasures like McDonald's breakfasts and Coca-Cola. For Warren, money has always been a tool, not a trophy. His focus has been on creating value, both for his shareholders and for society. Lessons for us all. Warren Buffett's journey isn't just a playbook for investing, it's a guide for life. His story teaches us to remain curious, persistent, and principled. Whether you're investing in stocks or your personal goals, the principles of value, patience, and integrity will always yield dividends. The Oracle of Omaha has shown us that wealth is not just about accumulating money, but about mastering the art of creating and nurturing opportunities, something we can all aspire to in our own lives. How Warren Buffett turned $105,000 into $30 billion was a masterclass in Contrarian Strategy. Warren Buffett's journey from $105,000 net worth in the 1950s to over $30 billion by the early 21st century is the stuff of legend. But behind the staggering numbers lies a philosophy rooted in discipline, contrarian thinking, and a keen understanding of business fundamentals. Let's dive into his strategy, told as a story of transformation and punctuated with actionable lessons. The early days, a seed of opportunity. In 1956, a young Warren Buffett began his investment partnership with $105,000 pooled from friends and family. Buffett didn't aim to chase market trends. Instead, he searched for undervalued companies with strong fundamentals that others had overlooked. Cigarette butt stocks, as he called them back then. Buffett's philosophy was simple. 1. Seek value others miss. He believed the market often underpriced great companies due to short-term pessimism. 2. Preserve capital. He avoided speculative risks, ensuring his investments were well-researched and deeply discounted. The Berkshire Hathaway pivot, a lesson in strategy. Buffett's acquisition of Berkshire Hathaway is often cited as a mistake turned into a masterstroke. Initially a struggling textile company, Berkshire became the vehicle through which Buffett applied his investment genius. He transitioned from investing in mediocre businesses at a good price to acquiring great businesses at a fair price. This marked the beginning of his focus on companies with what he called a durable competitive advantage, businesses with strong brands, pricing power, and the ability to withstand competition over decades. Exploiting bear markets, turning fear into opportunity. Buffett's strategy thrives in bear markets. While others panic, Buffett views downturns as clearance sales on excellent businesses. Case study, Coca-Cola. In the late 1980s, Buffett invested heavily in Coca-Cola, recognizing its brand dominance and global appeal. Despite a soaring market, he patiently waited for a dip, then bought in. By the late 1990s, Coca-Cola's stock had skyrocketed, and Buffett's stake had grown to billions. Key lesson: when markets are fearful, focus on long-term value rather than short-term panic. Buffett's contrarian mindset turns fear into fortune. The role of patience and compounding. Buffett often compares investing to planting a tree. It takes time for the fruits of your labor to grow. His wealth is a testament to the power of compound interest. By reinvesting earnings and holding investments for decades, Buffett let his capital snowball. Example: by reinvesting dividends and earnings from his holdings, Buffett created exponential growth. A single $10,000 investment in one of his early acquisitions often grew into millions over decades. Key lesson: start early and stay patient. Time is the investor's most powerful ally. Mathematics meets simplicity. Despite his deep knowledge, Buffett's methodology is surprisingly straightforward. He calculates the intrinsic value of a company by estimating its future cash flows and discounting them to present value. If the stock price is significantly below this intrinsic value, he buys. Formula: Buffett uses tools like the discounted cash flow DCF model to evaluate whether a company is a bargain. He prefers to invest only if he can project a compounding annual growth rate (KIA) that meets his desired threshold, often around 15%. Key lesson: learn to calculate a company's intrinsic value. Invest only when the price offers a significant margin of safety. When to sell. Lessons from Coca-Cola. Buffett rarely sells his investments, but when he does, it's strategic. In 1998, at the height of Coca-Cola's valuation, Buffett sold 17% of his holdings at an incredible 167 times the company's earnings. The move was carefully timed to maximize returns without jeopardizing his remaining stake. Key lesson: sell only when the valuation no longer supports future growth or when a better opportunity arises. The Internet era, a level playing field. Buffett began investing in a pre-digital age, but his principles are even more relevant today. The Internet has democratized financial information, giving individuals tools once reserved for Wall Street titans. With access to financial reports, stock data, and calculators, anyone can mimic Buffett's analytical rigor. Actionable insight. Leverage online tools to evaluate stocks like a pro. Websites like CC's Edgar database or free financial platforms can help you apply Buffett's methods. Your takeaway blueprint. Buffett's journey is both a story of disciplined investing and a template for success. Here's how you can emulate his approach. 1. Focus on quality. Look for companies with durable competitive advantages, strong brands, market leadership, and consistent profitability. 2. Buy during fear. Exploit market pessimism to buy great companies at bargain prices. 3. Think long-term. Allow compounding to work its magic by holding investments for decades. 4. Learn the math. Master simple valuation techniques like discounted cash flow to determine when a stock is undervalued. 5. Stay patient. Avoid the noise of market trends. Wealth building is a marathon, not a sprint. By following these principles, you may not turn $105,000 into $30 billion, but you'll set yourself on a path to financial independence. And as Buffett himself often says, the best investment you can make is in yourself. Why Warren Buffett doesn't play the stock market, and how that made him America's #1 investor. A fool sees, a wise man acts. Warren Buffett, often called the Oracle of Omaha, is revered as one of the greatest investors of all time. But what's fascinating is how Buffett's approach is less about playing the stock market and more about observing the game from the sidelines, and then strategically entering only when the odds are firmly in his favor. As poet William Blake said, "A fool does not see the same tree that a wise man sees." Buffett's genius lies in seeing what others overlook, and nowhere is this more evident than in how he navigates the stock market. The unconventional investor. Buffett doesn't play the stock market in the way most investors do. He avoids trends, shuns the frenzy of Wall Street, and has never been swayed by the fads of the moment. You won't find him charting stock prices, chasing momentum, or getting caught up in the latest craze. Instead, Buffett has built his fortune, starting with $105,000 and growing it into over $30 billion, not by chasing returns, but by exploiting the very behaviors that lead others astray. His secret? Understanding that short-term thinking leads to long-term mistakes. The power of pessimism. Most investors, whether individuals or massive institutions like mutual funds, are driven by short-term motivations. They buy stocks when there's good news and sell them when bad news strikes. It's a herd mentality that Buffett calls sheer madness, but it's also a goldmine for someone like him. When bad news hits and stock prices plummet, Buffett doesn't panic. He acts. He knows that many of these companies are being sold off not because their long-term prospects have fundamentally changed, but because of fear and short-term thinking. For example, during the recession in 2000, insurance companies faced heavy pessimism. Allstate stock plummeted to $19, and Berkshire Hathaway's shares fell to $40,800. Buffett saw opportunity where others saw disaster. Within a year, Allstate rebounded to $40 a share, and Berkshire Hathaway's shares skyrocketed to $70,000, a stunning return for those who ignored the panic and followed Buffett's lead. Lessons from Buffett's playbook. Buffett's success boils down to two core insights. 1. Short-term thinking dominates the market. Around 95% of investors focus on immediate gains, reacting to daily headlines and market fluctuations. They buy on good news and sell on bad news, often without considering the true long-term value of a business. 2. True value emerges over time. A company's real worth lies in its long-term economic fundamentals, not in the momentary swings of its stock price. Businesses that are undervalued due to bad news will eventually be reappraised upward as their intrinsic value becomes evident. A strategy rooted in patience. Buffett's approach is simple. Wait for moments of widespread pessimism to push the price of strong businesses far below their intrinsic value. When others are panicking, Buffett goes shopping. This strategy explains why Buffett steered clear of the dot-com bubble and countless other market manias. While investors poured their money into high-tech stocks like Yahoo, Amazon.com, and Priceline, Buffett stayed on the sidelines. He wasn't lured by the promise of quick riches, understanding that these overhyped companies often lack the strong economic fundamentals necessary for long-term success. Instead, he focused on buying companies with solid businesses, strong leadership, and undervalued stocks. Key takeaways. 1. Ignore the crowd. Buffett doesn't chase popular investments or hot trends. He seeks undervalued opportunities that others overlook. 2. Think long-term. The stock market is driven by short-term news, but true wealth comes from understanding the long-term economic value of a business. 3. Buy on bad news. When fear grips the market, prices often drop below a company's true worth. This is when Buffett strikes. 4. Understand human behavior. Buffett's genius lies in exploiting the short-term mindset of other investors, capitalizing on their mistakes to build his fortune. Wisdom in simplicity. As Buffett famously said, the most common cause of low stock prices is pessimism. We like pessimism because of the stock prices it produces. By staying grounded in fundamental principles, avoiding the noise of Wall Street, and waiting for the right opportunities, Buffett has turned the chaos of the stock market into a machine for building wealth. And that's a lesson every investor can take to heart. Warren Buffett's art of making good profits from bad news. In the world of investing, few lessons are as valuable as the ones Warren Buffett imparts through his approach to making profits in the face of bad news about a company. His strategy is not just about being a contrarian, it's about being selectively contrarian. Let's unravel this concept through a story-driven exploration. The Tale of Mr. Market. Imagine you own a small, thriving business with an equal partner named Mr. Market. Each day, Mr. Market offers to sell you his half of the business. However, there's a catch. Mr. Market's mood swings wildly. On good days, he's ecstatic, convinced the business is priceless, and sets an exorbitantly high price. On bad days, he's gloomy and pessimistic, offering to sell his share for a steal. Benjamin Graham, Buffett's mentor, introduced this metaphor to Warren early in his career. The lesson? Mr. Market's erratic emotions should guide neither your perception of the business's value nor your decisions. Instead, use his mood swings to your advantage. Buy when pessimism drives prices down. The short-term game versus long-term vision. Wall Street, mutual fund managers, and day traders are often trapped in the short-term game, prioritizing quick wins. This behavior stems from pressure. Investors demand immediate results, and underperformance can mean losing clients, or worse, jobs. As a result, many sell stocks at the first sign of bad news, driving prices lower, regardless of the company's long-term potential. Warren saw an opportunity in this behavior. While others panicked and sold shares in response to bad earnings reports or market fears, Warren understood that bad news often presents a mispricing opportunity, especially when it involves companies with durable competitive advantages. Selective contrarianism, a case in point. Consider Buffett's 1974 purchase of Washington Post shares at approximately $6.40 each, a time when pessimism clouded the market. Over 27 years, these shares appreciated to nearly $500 apiece, yielding an annual compounding rate of return of 17.8%. Similarly, his 2000 acquisition of H&R Block shares for $28 each, when the market was bearish, saw those shares soar to $60 within a year, delivering a 41% pre-tax return. These examples illustrate Warren's brilliance. He didn't just buy because prices fell. He bought because the businesses had enduring strengths. They were exceptional, resilient, and capable of bouncing back from temporary setbacks. The power of durable competitive advantage. What sets Warren apart is his focus on companies with what he calls a durable competitive advantage. These are businesses with strong economic engines. Think Coca-Cola, Disney, or American Express. Even when bad news drives their stock prices into the ground, these companies possess the structural strength to recover and thrive. Buffett's ability to identify these companies is rooted in rigorous analysis. He examines 1. Economic moats. Does the company have a unique advantage that keeps competitors at bay? 2. Consistent earnings power. Can it generate stable profits even in tough times? Strong management. Are the leaders capable and forward-thinking? The gift of pessimistic short-sightedness. Warren often says, be fearful when others are greedy, and greedy when others are fearful. This philosophy shines in his response to pessimistic markets. For Warren, bad news, whether it's a missed earnings report or market-wide panic, isn't a deterrent, it's an invitation. It's during these moments that he finds opportunities to buy world-class businesses at bargain prices. Key takeaways for aspiring investors. 1. Selective contrarian strategy. Don't just buy any stock that has fallen. Ensure the business has exceptional economics and a durable competitive advantage. 2. Patience pays. Ignore the short-term noise of the market. Invest with the confidence that great businesses recover and thrive. 3. Learn from Mr. Market. Use market pessimism to your advantage. Buy when prices are irrationally low due to temporary setbacks. 4. Durable competitive advantage is king. Focus on businesses with enduring strength that can weather storms and grow over time. Conclusion. Warren Buffett's success is a testament to the power of thinking long-term, staying disciplined, and capitalizing on the market's short-sightedness. By understanding his selective contrarian approach and focusing on businesses with durable competitive advantages, you too can turn bad news into great profits. As Warren has shown, the real magic lies in staying calm when others panic and seizing opportunities when they arise. Are you ready to think like Warren and let Mr. Market work for you? How Warren Buffett exploits the market's short-sightedness. Let's journey into Warren Buffett's investment strategy, a masterclass in exploiting the stock market's pessimism. Imagine a stormy sea of bad news rocking the stock market. While many investors jump ship, Warren sees an opportunity to find gems hidden beneath the waves. To capitalize on the market's short-sightedness, Warren searches for businesses that not only withstand the storms of bad news, but thrive once the clouds clear. These aren't just good companies. They're extraordinary ones with solid economics and the potential for long-term prosperity. The tale of two horses, healthy versus sickly. Picture this, you're at an auction with two racehorses on offer. One horse, healthy, has a history of winning races and generating earnings. The other, sickly, has been plagued by underperformance. Both horses catch the flu and their value plummets, prompting their owners to sell them. Who would you bet on? Healthy, of course. Even in sickness, its proven track record suggests a higher likelihood of recovery and future wins. Sickly might recover too, but its history indicates a cycle of recurring failures. Warren applies this same logic to businesses. He divides companies into two categories. One, sickly, price-competitive businesses offering generic products or services. These operate in crowded markets where competition is fierce, leaving little room for significant profits. 2. Healthy, companies with a durable competitive advantage, like a strong brand or monopoly-like control of their market. These firms face minimal competition and can raise prices, ensuring sustained profitability. The key to exploiting the market. Warren's strategy hinges on one crucial skill, the ability to distinguish between healthy and sickly businesses. Without it, investors risk betting on companies that fail to recover. Healthy companies often face temporary setbacks, perhaps a bad earnings report or broader market fears, but their strong underlying economics ensure they bounce back stronger than ever. Sickly companies, on the other hand, might never escape their cycle of mediocrity. Baseball and billion-dollar swings. Warren's investment approach draws inspiration from baseball legend Ted Williams, who mastered the art of selective swings. Williams divided his strike zone into 77 cells and only swung at pitches in his optimal hitting spots. Warren adopted this strategy for investing. He identifies his strike zone as healthy companies that are temporarily undervalued. Unlike baseball, where a batter faces the pressure of 3 strikes, Warren has the luxury of infinite patience. He lets mediocre opportunities pass until the perfect pitch, a mispriced healthy company, comes his way. Then he swings with conviction, making billion-dollar bets that often turn into home runs. The lessons from Warren's playbook. Here's what we learn from Warren's strategy. 1. Businesses fall into 2 categories: healthy, durable competitive advantage, and sickly, price competitive. 2. Healthy companies act like monopolies, often producing unique brand-name products or services that give them pricing power. 3. Sickly companies struggle with competition, offering generic goods or services that limit their ability to grow profits. 4. To exploit the market's pessimism, you must distinguish between healthy and sickly businesses with precision. 5. Patience is key. Wait for the market to misprice healthy businesses, then seize the opportunity. By following this playbook, Warren has turned investments in companies like Geico and the Washington Post into astronomical returns, all while harnessing the market's tendency to panic. What's next? In the following chapters, we'll dive deeper into how to identify these 2 types of businesses. You'll learn to spot the characteristics of healthy companies with durable competitive advantages, ensuring you can swing at the right pitches when the time comes. The interplay between profit margins and inventory turnover, lessons from Warren Buffett. Let me tell you a story about a young entrepreneur named Sam, who set up a lemonade stand in a scorching desert town. Sam's journey will illuminate how businesses make investors wealthy and why Warren Buffett is one of the greatest investors of all time. The foundations of profit and turnover. Sam's lemonade stand is a simple business. It costs $2 to make a glass of lemonade, and Sam sells it for $3. That $1 difference is the profit margin. But Sam soon learns something important. Just having a $1 profit margin doesn't mean instant riches. Sam keeps one glass of lemonade ready to sell at all times. If only 10 thirsty tourists buy a glass all year, Sam earns $10 in profit. That's 10 glasses sold, with each yielding $1. This is inventory turnover, the number of times Sam's stock is sold and replenished in a given period. If Sam wants to make serious money, something has to change. Either the profit margin needs to go up, charging more per glass, or the inventory turnover has to skyrocket, selling more glasses. 2 paths to riches. 1. High profit margins. Suppose Sam realizes the desert town has no other lemonade stands, making him a monopoly. Now, he charges $50 per glass instead of $3. With the same $2 cost, his profit margin explodes to $48 per glass. If he sells just one glass, he's already far ahead. 2. High inventory turnover. Instead of raising prices, Sam decides to stick to $3 per glass but attracts a massive crowd of thirsty tourists by promoting his stand. He sells 1,000 glasses in a year. That's $1,000 in profit from sheer volume. Warren Buffett loves businesses that combine both high profit margins and high inventory turnover. This is the ultimate recipe for success. However, as Sam's story shows, even excelling in one of these areas can lead to great wealth. The danger of being average. Now, imagine another lemonade stand across town where the price remains $3, but there are dozens of competitors. This means Sam's rival has to lower prices to attract customers, slashing profit margins to just a few cents. At the same time, the crowd is split among all the stands, so turnover remains low. This is the worst-case scenario. Low profit margins and low inventory turnover. A business like this struggles to survive, let alone thrive. Warren Buffett steers clear of such companies because they lack a competitive edge. Finding a durable competitive advantage. Let's return to Sam, who discovers a secret weapon: branding. He uses only the finest lemons, markets his drink as Sam's signature lemonade, and delivers a taste that tourists rave about. Suddenly, even when Sam opens a stand in a crowded area, customers seek him out specifically. This is the power of a durable competitive advantage, or what Buffett calls a moat. Like Coca-Cola, Nike, or Hershey, businesses with strong brands, unique products, or market dominance can charge higher prices and maintain strong profit margins. Warren's investing wisdom. Warren Buffett's strategy revolves around identifying companies like Sam's that have 1. High profit margins, 2. High inventory turnover, durable competitive advantages. He avoids businesses stuck in price wars, where low profit margins and weak turnover make survival a constant struggle. Instead, Warren waits for opportunities, when the market misjudges a great company's value and swoops in to buy at a discount. Key takeaways. Profit margins, turnover, the best businesses excel in both. If you can't find both, look for at least one straight. Avoid weak businesses. Companies with low margins and low turnover are risky and unlikely to generate wealth over time. Moats matter. A strong brand or unique edge can make a company resilient and consistently profitable. Patience pays. Warren doesn't rush. He invests when high-quality businesses are undervalued due to market short-sightedness. By mastering these principles, you can start thinking like Warren Buffett, spotting opportunities in a sea of mediocrity and building wealth that lasts. In the next chapter, let's dive deeper into how to distinguish a company with a durable competitive advantage from one doomed to price wars. This is the key to making smarter investment decisions. The hidden danger, the type of business Warren fears and avoids. A story of frogs and princes. Imagine you're walking through an enchanted forest. This isn't a regular forest. It's the vast and sprawling landscape of the investment world. Among the trees, streams, and clearings, you spot frogs hopping about. They're everywhere. Some have dazzling colors, some croak loudly, and others are perched on lily pads adorned with shiny trinkets. These frogs are what Warren Buffett calls price-competitive sick businesses. Like the frogs of fairy tales, some investors believe they can kiss these businesses and turn them into princes. They hope that with just the right touch, these struggling companies will transform into wealth-generating dynasties. But Warren, ever the realist, knows the truth. Frogs don't turn into princes. Instead of betting on these fragile creatures, Warren spends his time looking for something better. Businesses with a durable competitive advantage. These are the regal swans of the investment forest. Rare, resilient, and built to thrive in the long term. The trap of price-competitive businesses. What exactly makes these frogs so unattractive? Price-competitive businesses operate in industries where price is king, the deciding factor for customers. Let's step into the shoes of a consumer for a moment. When buying gas, do you care about the brand, or do you simply choose the station with the lowest price? When choosing an airline, does the logo matter as much as the ticket price? These industries, commodities, airlines, internet services, steel production, and even automobiles, are riddled with competition. They lack the magic ingredient Warren cherishes, the ability to charge a premium because of unique and enduring qualities. A vicious cycle. Let's follow the journey of Company A, a price-competitive business. One day, its management finds a way to lower production costs, boosting profits. Flush with success, they lower prices to capture market share from competitors B, C, and D. But soon, B, C, and D catch up. They adopt similar cost-saving measures and drop their prices. The market spirals into a price war, eroding everyone's margins. Instead of reinvesting profits into growth, these companies must funnel money into constant upgrades just to keep up. Worse, many carry huge long-term debts, sinking deeper into financial quicksand when market conditions sour. For example, in the 1990s, General Motors GM earned $34 billion but was weighed down by $136 billion in long-term debt. Ford needed nearly 4 decades of its historical earnings just to pay off its debt burden. Even the best managers can't overcome such poor economics. Buffett sums it up neatly. When a great management team encounters a bad business, it is the reputation of the business that remains intact. Share lessons from the textile industry. Warren often shares the cautionary tale of Burlington Industries, a textile manufacturer. In 1964, its stock price hovered around $30. Over the next 2 decades, Burlington spent $3 billion improving efficiency and expanding operations. By 1985, sales had grown, but in inflation-adjusted terms, the company was earning less. The stock price had barely budged to $34. The textile industry, plagued by overcapacity and relentless price competition, made it impossible for Burlington to reward its shareholders. This is why Warren avoids such industries. No matter how skilled the management, the economics simply don't allow for long-term success. The illusion of opportunity. Price-competitive businesses occasionally show glimmers of promise, especially during boom cycles. When demand for computer memory chips spikes, companies like Micron Technology rake in profits. During peak travel seasons, airlines report record earnings. But the good times rarely last. As demand softens, excess supply leads to plummeting prices, eroding profits, and sending stock prices into a nosedive. For Warren, this cyclical pattern isn't worth the gamble. What to look for instead? Instead of chasing price-competitive businesses, Warren seeks companies with durable competitive advantages, such as strong branding, proprietary products, or industry dominance. The ability to raise prices without losing customers, ensuring steady profits regardless of economic conditions. These companies don't just survive downturns, they thrive over decades, compounding shareholder value and turning modest investments into fortunes. Key takeaways. 1. Avoid the frogs. Price-competitive businesses lack the economic strength to withstand downturns or generate consistent long-term growth. 2. Durable advantage wins. Seek businesses that can charge premium prices and sustain profitability without constant reinvention. 3. Beware of debt. Companies burdened by excessive long-term debt are vulnerable to economic shifts. 4. Trust the business model. Even the best management can't fix the flaws of an inherently weak business. As you navigate the investment forest, remember Warren's wisdom. Don't waste time kissing frogs. Instead, seek the regal swans, the businesses with true competitive advantages that will glide gracefully through booms and busts alike. The Castle, the Moat, and the Wise Investor. Imagine you're a medieval king, building a kingdom to last for generations. Your castle is magnificent, but what ensures its survival isn't just its grandeur, it's the moat that surrounds it, deep and wide, keeping invaders at bay. For Warren Buffett, this castle and moat metaphor perfectly illustrates his investment strategy. Find businesses with strong moats, those with a durable competitive advantage. The bubble that didn't burst Buffett's philosophy. During the dot-com bubble, as the world gushed over the revolutionary potential of the internet, Warren remained steadfast in his approach. While others were dazzled by promises of growth and societal transformation, Warren asked a simpler question. What is the company's competitive advantage, and how durable is it? This focus on competitive advantage is at the heart of Warren's philosophy. Companies with these advantages can earn monopolistic profits, giving them the strength to weather market storms. But what really matters is the durability of that advantage, the ability to fend off competition and maintain profitability for decades. 2 types of competitive advantage. Warren identifies 2 primary sources of competitive advantage. 1. Unique products. These are goods that customers are loyal to and associate with a specific brand. Think Coca-Cola, whose signature soda has remained virtually unchanged for over 80 years. 2. Unique services. Services that address ongoing consumer needs. For example, H&R Block helps people navigate the ever-complicated tax filing process, an enduring necessity. At the right price, Warren is willing to invest in either type, provided the competitive advantage is durable. The durability is what ensures these businesses remain predictable and profitable over the long term. The durable advantage, a teaching moment. Durability, Warren emphasizes, is the cornerstone of his selective contrarian philosophy. Let's break it down using 2 types of businesses. Low-cost durability. Take Hershey's chocolate. It's a product that has delighted consumers for over 70 years. Generations of families have grown up enjoying the same treats with little change to the product. Because Hershey's doesn't need to invest billions in reinventing its offerings, it has a low-cost durability. This allows the company to funnel profits to shareholders rather than maintenance or innovation. High-cost challenges. Contrast this with Intel, a giant in the tech industry. Intel's competitive advantage lies in its ability to innovate, but that comes at a steep price. Billions spent annually on research and development. If Intel fails to produce cutting-edge chips, its competitive advantage evaporates. Warren avoids such businesses because their profitability depends on high-cost reinvention rather than steady, predictable products. How to identify a great business. So how does one spot a company with a durable competitive advantage? Warren offers a checklist. 1. Long-standing products or services. Has the company been selling the same core product or service for a decade or more? If yes, it's likely to continue doing so. 2. Repeat consumer needs. Does the business address a need that recurs frequently, like hunger, Taco Bell, or taxes, H&R Block? 3. Brand loyalty. Are customers so loyal to the product or service that they won't switch to competitors? Coca-Cola and Marlboro are prime examples. 4. Capital efficiency. Can the company maintain its competitive advantage without constant, costly reinvestment? Hershey's and Coca-Cola excel here, while companies like Intel or investment banks often fall short. Why moats matter? Warren's insistence on durable competitive advantage isn't just about making money. It's about predictability and peace of mind. A business with a strong moat doesn't just survive, it thrives. Its profits are consistent, and it doesn't require constant reinvention to stay relevant. Even an inexperienced manager could run it, and it would still succeed. Key takeaways. 1. Focus on moats. Don't get swept up in hype about growth or societal change. Look for companies with a strong competitive advantage. 2. Durability is king. A long-lasting product or service is the hallmark of a great investment. 3. Low-cost maintenance. The best businesses don't require massive reinvestment to maintain their edge. 4. Repetition is good. Products or services tied to repetitive consumer needs are Warren's favorites. By sticking to these principles, Warren has built a fortune and a philosophy that endures like a castle protected by a deep, unyielding moat. The Tale of Two Investments. Lessons from Warren Buffett's timeless wisdom. Once upon a time, in the bustling world of Wall Street, investors were abuzz with talk of the latest high-tech boom. It was the year 2000, and everyone was chasing the shimmering dream of internet riches. Amidst this frenzy stood Warren Buffett, calm and unmoved, like a lighthouse guiding through the stormy sea of market mania. His steadfast approach, grounded in logic and timeless principles, saved him, and could save others, from financial catastrophe. The allure of transforming industries? Buffett often watched as investors raced to pour money into transformative industries, chasing visions of grandeur. These industries, be it the internet, biotech, or the automobile sector decades earlier, offered dazzling promises of reshaping the world. Yet, Buffett knew that beneath the glitz lay brutal competition and unpredictable futures. Take the automobile industry. Between 1919 and 1939, over 300 car manufacturers sprang up, yet fewer than 10 survived. Similarly, by 1992, airlines had collectively lost more than they had ever earned. Even the internet, once hailed as a revolution, saw its darlings crumble into bitter memories. The lesson? Transforming industries often lack one critical element, a durable competitive advantage. Buffett's secret weapon? Durability. Warren Buffett's approach hinges on one question. Is this business durable? He looks for companies with a proven track record, solid earnings, and competitive moats that fend off rivals. Emerging industries often fail this test because they're still evolving, their paths uncertain, and their products untested over time. This lack of durability leads to fierce competition, lower profits, and ultimately plummeting stock prices when the initial euphoria fades. For Buffett, these characteristics make transforming industries fundamentally unattractive. Instead, he turns his attention to established businesses with real earnings and sensible price tags. The market cap thought experiment. Buffett's investment philosophy is built around a simple yet powerful thought experiment. Imagine you had enough money to buy an entire company. Would it be worth it at the current market price? If the answer is no, then it's not worth buying even a single share. Let's break it down using two contrasting examples. 1. Yahoo in 2000. Trading price $178 per share. Market cap $97 billion. Expected earnings $70.8 million. If you had $97 billion, would you trade it for Yahoo? Likely not. You could invest the same money in U.S. Treasury bonds and earn $6.7 billion annually, a far more reliable return. For Yahoo to match this, it would have to grow its earnings astronomically year after year, an unlikely prospect in an uncertain industry. 2. Allstate in 2000. Trading price $18 per share. Market cap $13.4 billion. Annual earnings $2.2 billion. Buying Allstate at its market price would yield a return of 16.4% annually, a far better deal than Yahoo or even Treasury bonds. Despite being part of the old economy, Allstate offered real value and stability, making it a quintessential Buffett pick. The results of contrasting decisions. Suppose you invested $50,000 in Yahoo at its peak in March 2000. By April 2001, your investment would have plummeted to just $4,015, a staggering 91% loss. In contrast, investing the same $50,000 in Allstate during its undervalued period would have grown to approximately $111,111, delivering a 102% gain. Buffett's wisdom lies in recognizing that true wealth is built on solid foundations, not fleeting trends. Key takeaways for aspiring investors. 1. Durability first. Never invest in businesses without a proven competitive advantage. Transforming industries often fail this test, making them risky bets. 2. Think like an owner. Ask yourself, if I could buy the entire company at its market price, would it be worth it? If not, don't buy even a single share. 3. Beware of bubbles. Frenzied markets often inflate stock prices far beyond economic reality. Remember, gravity always wins. What goes up unsustainably will come crashing down. 4. The power of patience. Investing in undervalued, durable companies may not seem glamorous, but it consistently outperforms chasing trends. As the internet boom turned bust, Buffett's all-state investment flourished, proving yet again the wisdom of his selective and contrarian approach. For those willing to learn, his philosophy is a beacon in the often murky waters of investing. Invest in what lasts, not in what dazzles. Interest rates and stock prices. How Warren capitalizes on what others miss. Picture this. Warren Buffett, the Oracle of Omaha, sits in his modest office, poring over financial statements. To the untrained eye, the world of stocks and bonds might seem like a chaotic whirlwind of numbers and trends, but to Warren, it's a well-rehearsed dance, one that moves to the rhythm of interest rates. Let's take a moment to uncover the connection between interest rates and stock prices through Warren's perspective. The dance between stocks and bonds. Warren firmly believes that all investment returns are intertwined. The earnings from a business must compete with the returns an investor can get from bonds, real estate, or any other investment. This competition helps determine the price of a business, and ultimately, its stock. At the heart of Warren's philosophy lies a simple truth. A business is worth what it earns over time. Not the market hype, not the speculative trends, just the cold, hard earnings it generates. Sometimes the stock market prices a business too high or too low, but in the end, reality catches up with expectations. An example, comparing business earnings to bond returns. Imagine you're evaluating a business that earns $100,000 a year, year after year, as reliably as the sunrise. The big question is, what would you pay for it? To answer this, you compare it with bonds, the closest rival in the investment world. If AAA-rated bonds pay 10% annually, you'd need $1 million worth of bonds to generate the same $100,000 annually. 1 million times 10% equals $100,000. So if someone tries to sell you that business for $1.5 million, your return drops to 6.7%, 100,000 to 1.5 million, much lower than the bond's 10%. Logically, you'd pass on the business and buy the bonds instead. Now, consider what happens when bond interest rates fall to 5%. That same $1.5 million in bonds now earns only $70,000 annually. 1.5 million, 5%, 75,000. Suddenly, the business earning $100,000 looks much more attractive. In this case, lower interest rates put upward pressure on the business's price. The Fed's role, a conductor of economic tempo. The Federal Reserve, the Fed, is like the conductor of the economy's orchestra. When it lowers interest rates, borrowing becomes cheaper. Businesses expand, consumers spend more, and the economy heats up. Stock prices, reflecting the rising value of businesses, soar. Conversely, when the Fed raises interest rates, borrowing becomes expensive. Businesses cut back, consumers spend less, and the economy cools. Stock prices, tied to the declining value of businesses, fall. This isn't just theoretical. Think back to the late 1990s. The economy overheated, inflation threatened, and the Fed raised interest rates to cool things down. Then came 2001. The economy slowed and the Fed slashed rates to reignite growth. A bubble bursts when the market ignores fundamentals. There are times when the market dances to its own beat, ignoring the Fed's tempo. In a bubble, prices skyrocket, detached from earnings. Investors chase momentum instead of value. When the Fed intervenes, raising rates to rein in the frenzy, the market eventually corrects, often dramatically. Key takeaways. Lessons from Warren's playbook. 1. Higher interest rates make earnings less valuable to investors. This puts downward pressure on stock prices. 2. Lower interest rates make earnings more valuable to investors. This drives stock prices up. 3. The stock market and economy ultimately align with the Fed's policies. While short-term deviations happen, long-term trends always follow the beat of interest rates. Warren's genius lies in understanding this dance better than most. By keeping a steady eye on earnings and their relationship with interest rates, he consistently spots opportunities where others see chaos. And now, so can you. Solving the puzzle of the bear bull market cycle. Lessons from Warren Buffett. The market cycle, a story of opportunity. Imagine the stock market as a roller coaster, a thrilling ride filled with climbs and dips, highs and lows. To many, these ups and downs bring uncertainty and fear. But for Warren Buffett, the legendary investor, this cycle isn't a source of anxiety. It's an intricate puzzle to solve and an opportunity to seize. His ability to master the rhythm of this cycle sets him apart, allowing him to thrive where others falter. Let's unravel how Warren uses the bear bull market cycle to his advantage, combining his selective contrarian approach with a keen eye for timing. 1. The bear market, a hunter's paradise. In the dense forest of the stock market, a bear market is like a harsh winter. Prices fall, businesses struggle, and investors panic. This is when Warren sharpens his tools. Unlike others who flee, Warren sees the bear market as a rare and valuable chance to hunt for bargains. Key lesson: a bear market is the land of opportunity for the selective contrarian investor. Strong companies, those with durable competitive advantages, are often sold at a fraction of their worth. The pessimism of the market creates what Warren calls easy pickings. For example, during the 1973-74 bear market, Warren scooped up shares in the Washington Post and night-ridder newspapers at rock-bottom prices. These companies weren't struggling, the market simply undervalued them. When the market recovered, Warren's patience paid off handsomely. PART2, the transformation from bear to bull. As winter gives way to spring, the bear market eventually transitions into a bull market. How? Typically, economic policies like lowering interest rates stimulate growth, making stocks more attractive. Prices start to climb, and cautious optimism turns into euphoria. During this phase, Warren holds on to his carefully selected investments. He knows the true value of the businesses he owns and waits for the market to recognize it. Key insight: buy when others are fearful and hold when others are greedy. Warren's power lies in his discipline. He invests in great companies during bear markets and watches them bloom during bull markets. PART3, corrections and panics. Short-term windows. Even in a bull market, not every moment is sunny. Corrections, short, sharp drops in stock prices occur. These moments of panic selling often send prices of otherwise strong companies plummeting temporarily. For Warren, this is like a flash sale at his favorite store. Take October 1987, when a market crash sent shares of Coca-Cola tumbling. While others panicked, Warren saw a golden opportunity. He acted quickly, acquiring shares of Coca-Cola, which later became one of his most profitable investments. Key lesson: corrections and panics don't change the fundamentals of strong companies. They're emotional blips in the market, moments when fear creates opportunities for decisive investors. 4. The bubble and its pop bull markets can morph into bubbles when irrational exuberance takes over. Investors chase profits at any cost, driving prices to unsustainable levels. Valuations lose touch with reality, and earnings no longer seem to matter. When this happens, Warren knows it's time to step back. Case study: in the late 1990s, during the dot-com bubble, tech stocks soared without any real earnings. Many investors got swept up in the hype, but Warren stayed cautious, recognizing the unsustainable nature of these valuations. When the bubble burst in 2000, Warren was ready with cash to scoop up undervalued gems. Key insight: when you hear that earnings no longer matter, it's a sign the bubble is about to burst. For the savvy investor, it's time to sell out of overheated sectors and look for opportunities in neglected ones. 5. The aftermath. Post-bubble bargains. When the bubble bursts, stock prices plummet and fear takes over once again. This is Warren's moment to shine. While others nurse their wounds, he uses his cash reserves to buy shares in undervalued companies with strong competitive advantages. After the 2000 crash, Warren invested in Yum Brands and H&R Block, capitalizing on the market's overselling of quality companies. Key lesson: the aftermath of a bubble offers incredible opportunities. But remember, not all companies will recover. Focus on those with durable competitive advantages, businesses with the strength to weather storms and thrive in the long run. What you should learn: the cycle brings opportunity. The bull-bear market cycle isn't just noise, it's a roadmap for investment opportunities. Durable competitive advantage matters. Seek companies with strong fundamentals that can endure market volatility. Be fearful when others are greedy. Timing and discipline are critical. Invest when prices make business sense, not when the crowd is euphoric. Cash is king in crashes. Keep reserves ready for bear markets and bubble bursts to capitalize on undervalued stocks. In the puzzle of the bear bull market cycle, Warren Buffett is the master solver. By combining patience, discipline, and an eye for true value, he turns market volatility into a strategic advantage. Follow his example, and you too can navigate the ups and downs of the market like a pro. How Warren Buffett discerns buying opportunities others miss. A story of wisdom in the chaos. Imagine a young investor walking into a crowded marketplace. The air is heavy with fear. News of industry collapses, corporate missteps, or global conflicts has gripped everyone. Prices are dropping, sellers are panicking, and uncertainty looms large. Yet amidst this chaos, one figure moves with calm precision, picking out gems others overlook. That figure is Warren Buffett. Warren's ability to see opportunity where others see only risk is legendary. Through his actions, he has turned crises into fortunes, guided by principles honed over decades. In this chapter, we delve into the scenarios that make up these opportunities and the lessons they teach. That one industry recessions, the silver lining in the storm. Industries are like tides. Sometimes they rise and sometimes they fall. During a recession, the entire industry suffers, and fear drives stock prices down. For Warren, these moments are invitations to buy great companies at bargain prices. Take the story of Capital Cities, ABC Inc. In 1990, as advertising revenues fell, the company projected stagnant profits, causing its stock price to drop from $63 to $38. Most investors fled, but Warren saw an opportunity. 5 years later, the stock merged with Disney and soared $125 per share, a reminder that industry recessions often reward patience and insight. Similarly, Warren invested in Wells Fargo during the 1990 banking crisis. Despite fears of real estate loan defaults, he recognized the bank's robust fundamentals and bought shares at 57s. 8 years later, the investment had grown exponentially. Lesson: focus on strong, well-capitalized leaders in industries facing temporary downturns. The storm will pass, leaving resilient companies to thrive. Act 2. Individual calamities, turning missteps into opportunity. Even the most brilliant companies make mistakes. The stock market often punishes them harshly, presenting a discerning investor with potential gold. Take Geico, which nearly went bankrupt in the 1970s after insuring high-risk drivers. When new management vowed to return to profitable practices, Warren invested heavily. His $45.7 million investment grew to $2.4 billion by 1996. Or consider American Express in the 1960s. A scandal involving non-existent collateral crushed its stock price, yet Warren saw that its durable competitive advantages, credit cards and travelers' checks, remained unshaken. His faith was rewarded with a $20 million profit. Lesson: differentiate between temporary setbacks and permanent damage. A company with a durable competitive advantage can recover from even severe missteps. 3. Structural changes, hidden value in transition. Corporate restructuring, mergers and spin-offs often create temporary chaos, negatively impacting stock prices. But Warren sees beyond the surface. For instance, he invested in Costco during a period of negative earnings caused by merger costs. He also saw opportunity in Sears when it announced a spin-off of its insurance arm, Allstate. These changes unlocked hidden value that others missed. Lesson: structural changes can disrupt earnings in the short term, but often position companies for long-term growth. Look for opportunities in the chaos. 4. The war phenomenon, courage amid uncertainty. War disrupts economies and sends stock prices plummeting. The panic is palpable, but so is the opportunity. After 9/11, stocks in travel-related industries, airlines, hotels, and cruise lines were decimated. Warren understood that travel would rebound, even if some companies failed. By discerning which ones could endure, he positioned himself for significant gains. Lesson: wars and global crises trigger fear-driven sell-offs. History shows recovery is inevitable, rewarding those with the courage to invest during uncertain times. 5. The perfect storm, combining bad news catalysts. The most lucrative opportunities often arise when multiple crises converge: an industry recession paired with war, or structural changes amidst a market panic. These rare scenarios amplify fear, driving stock prices to irrational lows. In these moments, Warren thrives. His disciplined approach to valuation, coupled with a focus on durable competitive advantages, allows him to identify investments others overlook. What you should learn: recognize patterns. Bad news situations fall into 5 categories: market corrections, industry recessions, individual calamities, structural changes, and war. Each creates unique opportunities. Focus on fundamentals. Look for businesses with strong competitive advantages that can weather temporary storms. Stay disciplined. Fear creates bargains. Courage and patience turn them into profits. By understanding these principles, you too can walk into the marketplace of fear and emerge with treasures, just like Warren Buffett. The Tale of Warren and the Quest for Hidden Wealth. Once upon a time, in the bustling world of commerce, Warren, a seasoned seeker of value, embarked on a quest to uncover companies with hidden wealth. This treasure wasn't locked away in chests or buried in secret vaults. It lay in something far more enduring: a durable competitive advantage. This advantage, forged through strategic insight, relentless innovation, and sometimes a stroke of luck, was the key to unlocking extraordinary wealth. Warren's journey led him to study how these advantages came into being. He discovered that companies with patents or copyrights held an immediate edge. These legal shields kept rivals at bay and ensured a consistent flow of revenue. Yet Warren's fascination was reserved for those companies that, through ingenuity and grit, built enduring advantages even in the fiercest of competitive landscapes. The story of the 2 newspapers. One day, Warren wandered into a small town where 2 local newspapers were locked in an unrelenting battle for readers. Both papers struggled to turn a profit, competing aggressively on price. Then a twist of fate changed everything. One newspaper, hampered by poor management, collapsed and was absorbed by its rival. The remaining newspaper suddenly found itself in a position of power. With no competitors left, it could increase advertisement prices, streamline operations, and pay down its debts. What was once a struggling enterprise became a fortress of profitability. Warren reflected on this transformation. A durable competitive advantage, he thought, is like a castle on a hill. Once secured, it's nearly impossible to conquer. Porsche and the power of specialization. Warren's next lesson took him to the dazzling world of luxury cars, where he encountered Porsche. While many automakers were locked in a relentless race to produce cheaper vehicles, Porsche had taken a different path. It specialized in creating cars that people wanted to be expensive, symbols of status, elegance, and superior craftsmanship. Warren observed that Porsche's high-end models often sold out faster than their more affordable ones. This clever pricing strategy produced exceptional profit margins, delighting its shareholders. By focusing on luxury and exclusivity, Porsche had established a durable competitive advantage in an otherwise cutthroat industry. The changing tides of television. But Warren also knew that even the mightiest castles could face storms. He studied the television networks of old, giants that had once reigned supreme over the airwaves. For decades, these networks enjoyed a durable advantage as viewers had few alternatives. Then came the digital revolution, bringing an explosion of channels and online content. The once dominant networks saw their grip loosen as competition surged. Even so, Warren recognized that true durability didn't fade overnight. He pointed to companies like Philip Morris, which thrived despite lawsuits and regulatory challenges. Its iconic product, Marlboro, remained the world's best-selling cigarette, a testament to the power of a well-crafted brand and a durable competitive edge. The secrets of fertile ground. Warren's journey revealed a vital truth. Some industries offered more fertile ground for durable competitive advantages. These industries, rich in innovation, branding opportunities, or market dominance, allowed companies to build unassailable positions. Whether through monopoly, specialization, or brand strength, businesses that thrived in these arenas became hidden treasures for those with the wisdom to spot them. A legacy of hidden wealth. And so Warren continued his quest, guided by timeless principles. He sought not just obvious riches, but the hidden wealth beneath the surface, a treasure built on strategy, resilience, and enduring competitive strength. Through his journey, Warren taught us all a vital lesson: to look beyond the noise, to find companies that had turned struggle into success, and to invest not merely in the present, but in the solid foundations of the future. The 4 pillars of competitive advantage. Warren discovered that businesses with durable advantages fell into 4 key categories. 1. The wisdom of Warren, finding fortune in familiar products. Businesses that fulfill repetitive consumer needs with products that are used up quickly or wear out fast, like snacks, beverages, or household items. 2. The advertising bridge, lessons from Warren's insights. Companies that provide advertising services, an essential expense for any business aiming to stay relevant. 3. The repetitive toll bridges, lessons in business simplicity and profitability. Firms offering services people or businesses need regularly, such as cleaning, pest control, and tax preparation. 4. The power of low-cost producers, lessons from Warren's playbook. Sellers and producers of essential goods who dominate their industries by keeping costs low and creating barriers to entry. Each of these categories represents a treasure trove of opportunity, revealing the enduring value of businesses that operate with foresight and a durable competitive advantage. The wisdom of Warren, finding fortune in familiar products. Warren, a sage in the world of investing, often shares his insights through stories that teach and inspire. Here are the tales of industries and products that capture his attention, those that fulfill repetitive needs, powered by brand name appeal. Fast food, serving up fortune. Warren often mused, nothing gets used up faster than fast food. Walking into his favorite brand name fast food restaurant, he admired how companies like McDonald's, Yum Brands, Taco Bell, KFC, and Pizza Hut and Burger King had transformed generic meals into iconic staples of modern life. By branding simple items like hamburgers and fried chicken, these companies secured loyal customers who returned again and again. Their secret? A combination of consistent quality, a vast network of restaurants, and sophisticated logistics. Warren learned that these businesses, with their high returns on capital and consistent earnings growth, were resilient even during economic downturns. They were practically recession-proof. Still, he knew that opportunities to buy shares often came during moments of panic, like a food safety scandal or market correction when prices dipped temporarily. Prescription drugs, modern-day alchemy. On a visit to the pharmacy, Warren pondered the power of pharmaceutical companies. These firms, such as Merck, Eli Lilly, and Bristol Myers Squibb, held patents for life-saving medicines. The patents acted as gates, and only those with prescriptions and the money to pay could pass through. Warren recognized the growing demand for these products in an interconnected world where diseases spread quickly and new cures were constantly needed. These companies earned exceptional returns and boasted histories of impressive growth. He recalled how, in the early 1990s, fear of government intervention had caused a temporary plunge in pharmaceutical stocks. Seeing the opportunity, Warren invested in Bristol Myers Squibb at a bargain. By 2001, his patience paid off handsomely with a substantial return on investment. Brand name foods, the taste of profit. Warren's next revelation came from the pantry. Companies like Kellogg's, Campbell's, Hershey's, and Kraft filled the shelves with products that had become staples of everyday life. When someone craved chocolate, they thought of Hershey's. When they wanted soup, Campbell's came to mind. These companies had embedded themselves in the consumer psyche, creating durable competitive advantages that translated to decades of profitability. Warren's advice? Buy these companies during bear markets or sell-offs when their stock prices dip, but their business fundamentals remained strong. Brand name beverages, liquid gold. With a bottle of Coca-Cola in hand, Warren reflected on the power of iconic beverages. Coca-Cola, PepsiCo, and Anheuser-Busch had been serving up the same products for decades. The strength of their brands created unmatched loyalty. Coca-Cola alone accounted for 30% of all liquids consumed in the US daily, an astonishing feat. The secret to success, Warren knew, was recognizing the enduring nature of these products and seizing opportunities to buy shares during market downturns. Toiletries and household products, everyday essentials. In the morning, Warren's routine included toothpaste, soap, and shampoo, products he knew were consumed by millions daily. Companies like Procter & Gamble, Colgate-Palmolive, and Gillette provided these essentials, boasting strong earnings and low debt. While their products evolved slightly, new mint flavors or better razor designs, their core offerings remained unchanged for decades. Warren believed these companies were bomb-proof, making them excellent long-term investments, especially when temporarily undervalued. Brand name clothing, fashioned for success. In a quiet moment, Warren thought about Levi Strauss, whose durable denim jeans had started as workwear for gold miners and evolved into a fashion statement. He marveled at how clothing brands like Levi's and Nike turned inexpensive production into premium-priced products by leveraging their names. Manufacturing was outsourced to the lowest bidder, but the real power lay with the brand owners, who commanded high prices for products that carried cultural significance. Companies like Nike and Liz Claiborne were proof that investing in the right brand could be immensely profitable. The key lesson: invest where durability lives. Through these stories, Warren taught a timeless lesson. The best investments often lie in businesses that fulfill repetitive needs with products consumers trust and love. Whether it's a hamburger, a soda, or a pair of jeans, these products become ingrained in daily life, creating wealth for those who recognize their enduring value. When the market panics, remember Warren's wisdom. Seek out these treasures when others are too fearful to act. In their brands lies hidden wealth, waiting for those with patience and foresight to uncover. The Advertising Bridge, lessons from Warren's insights. In the world of commerce, where products compete for consumer attention, advertising is the bridge that connects manufacturers to buyers. Warren's observations reveal the genius of this industry and its enduring profitability. Let's explore his insights through a series of illuminating stories. The Toll Bridge of Advertising. Imagine a bustling marketplace where merchants shout to sell their wares. Now imagine a world where they've gone silent, relying instead on colorful banners, jingles, and images to grab attention. This is the essence of advertising, modern-day persuasion. Warren understood that advertising isn't just about selling a product. It's about creating demand and maintaining a competitive edge. Once a company begins advertising, it cannot afford to stop. Competition ensures that if one company ceases, others will fill the void, seizing its market share. Advertising, Warren realized, functions like a toll bridge. Companies pay to cross it, reaching consumers on the other side. This toll is collected by advertising agencies, television networks, newspapers, and other media outlets, creating a consistent and lucrative revenue stream for those who own the bridge. The powerhouses. Advertising agencies. When global giants like General Motors or Philip Morris want to dominate the marketplace, they turn to advertising agencies. These firms craft campaigns that influence consumers worldwide. Take Interpublic, for example, the second-largest advertising agency which manages campaigns across 52 countries. Warren recognized its value during the 1973-74 recession, purchasing shares at bargain prices. He also invested in Ogilvy Group, betting on its ability to create compelling ads for America's biggest brands. Agencies like Omnicom Group remain at the heart of this industry, representing the toll bridge that manufacturers must cross to stay relevant. Television, the king of reach. Television stands as the crown jewel of advertising platforms, capable of reaching millions in an instant. A single 30-second ad during the Super Bowl costs millions, a testament to TV's unparalleled influence. Warren saw the potential early, investing in ABC in the late 1970s when its shares were undervalued. He marveled at the simplicity of the business model. Buy a transmitter, build an antenna, and broadcast content funded by advertising revenue. This business proved highly profitable, with low initial costs and steady income. Warren also invested in Capital Cities, a media company that capitalized on TV's dominance. Newspapers, local monopolies. In the world of print, newspapers often operate as monopolies within their regions. When Warren invested in the Buffalo Evening News, he experienced the power of such a monopoly firsthand. Once its competitor folded, the paper's profitability soared. Warren understood that a single newspaper could command premium advertising rates. It was the only bridge for local businesses to reach consumers. His investments in newspapers like Knight Ridder and the Washington Post were made during market downturns, allowing him to buy quality businesses at discounted prices. Magazines, niche fortresses. Magazines, with their specialized audiences, represent another powerful medium. Time, People, and Sports Illustrated dominate their respective niches, creating lucrative opportunities for advertisers. Warren's investment in Time Inc. during an early 1980s recession exemplifies his strategy of buying high-quality media assets when others were selling. He admired companies like Reader's Digest, which combined longevity, profitability, and zero debt, a rare trifecta in business. Direct mail and billboards, unsung heroes. While TV and print often steal the spotlight, Warren also recognized the profitability of direct mail and billboards. Companies like Advo, a leader in direct mail, excelled in targeted advertising. Billboards, too, offered consistent returns. Outdoor Systems, with its vast network of display spaces, reminded Warren of Ted Turner, who built his fortune in the billboard business before venturing into broadcasting. Lessons for investors. 1. Understand the toll bridge. Advertising is an essential service. Companies can't survive without it, making it a dependable source of income for those who control the platforms. 2. Buy during fear. Recessions and market corrections often lead to undervalued media assets. Warren seized these opportunities to buy shares at low prices and reap long-term rewards. 3. Recognize durability. The best investments lie in platforms with enduring appeal, whether it's a TV network, a newspaper monopoly, or a niche magazine. The advertising industry may evolve, but its core purpose, persuading consumers, remains unchanged. Warren's approach shows us how to spot opportunities in an ever-changing landscape and turn them into lasting wealth. The repetitive toll bridges, lessons in business simplicity and profitability. Imagine a bridge that people cross every day to get where they need to go. They pay a small fee each time, and as long as the bridge stands and people have somewhere to be, the tolls keep coming. Warren discovered that certain businesses operate just like this. They provide services people and companies consistently need, and they earn steady, repetitive income in the process. Let's explore these toll bridge businesses and the wisdom they hold for investors. The everyday heroes of service. Think about the things we all rely on but don't often consider. Clean homes, pest-free spaces, secure neighborhoods, and well-kept lawns. Companies like ServiceMaster have built empires around these needs, offering professional cleaning, pest control, and lawn care. Warren noticed that these businesses don't require cutting-edge technology or highly specialized workers. Instead, they rely on straightforward services performed by employees hired as needed. The result? High profits, low costs, and minimal risk. Then there's Rollins, the parent company of Orkin, the world's largest pest control service. Think about their home security services. Once a home is wired for security, the customer pays a monthly fee, sometimes for the rest of their life. It's a classic example of a toll bridge. Once the service is in place, the revenue flows steadily with little extra effort. Credit cards, tolls on transactions. Credit card companies like American Express represent another fascinating kind of toll bridge. Each time you swipe your card, American Express charges the merchant a fee. If you pay an annual membership fee for the card, that's another source of income. And if you carry a balance, you pay interest, often at sky-high rates. Millions of small transactions create enormous profits, and these companies don't need expensive factories or warehouses to operate. Warren also saw the value in companies like First Data Corp, which process these transactions. He invested during moments of market panic, seizing opportunities to buy into this lucrative toll bridge. Rental businesses, selling the same thing over and over. Imagine a business that rents out uniforms, entrance mats, and dust mops. Once the items are made, they can be rented repeatedly. This is the genius Cintas Corp, which earns steady income from businesses that constantly need uniforms for their employees. It's the same story with companies like Dun & Bradstreet, which provide businesses with vital information about other companies. They don't create something new each time. Instead, they sell the same information again and again. Companies like InfoUSA operate similarly, turning data into recurring revenue streams. Why these businesses work? Warren realized that the magic of these companies lies in their simplicity. 1. Low costs, high returns. These businesses don't need billion-dollar plants or massive research budgets. They hire workers at modest wages, train them quickly, and scale their workforce up or down as demand changes. 2. No obsolescence. Unlike technology companies, these services don't become outdated. People will always need pest control, security, clean uniforms, and reliable credit card transactions. 3. Minimal capital expenditures. Once the infrastructure is in place, there's little need for additional investment. The money these companies make can go directly into expanding operations, paying dividends, or buying back shares. Lessons for investors. Warren's investments in these repetitive service businesses offer timeless lessons. Look for essential services. Businesses that provide everyday needs are often more stable and profitable than those chasing trends. Invest in simplicity. The less complicated the business model, the easier it is to maintain profitability. Seize opportunities during fear. Market downturns often create the perfect chance to buy into these reliable toll bridges at discounted prices. These businesses may not grab headlines, but their steady, repetitive income streams make them the unsung heroes of the investing world. As Warren teaches us, sometimes the best opportunities lie in the simplest ideas. The Power of Low-Cost Producers. Lessons from Warren's Playbook. Imagine a store in your neighborhood where everything you need is cheaper than anywhere else. People flock there because they trust the quality, the service, and most importantly, the price. Over time, this store becomes a fixture in the community, an unstoppable force in its market. Warren Buffett, the legendary investor, saw the magic in this business model early on. Let's take a closer look at how low-cost producers and sellers dominate their fields and what we can learn from their success. The auto insurance example, Geico's edge. Warren's introduction to the power of the low-cost producer began with Geico, the auto insurance company. Auto insurance is something every car owner must have, and price is often the deciding factor. By offering the cheapest rates in town, Geico carved out a competitive advantage. But the real genius was in how Geico operated. It used a direct-to-consumer model, cutting out middlemen and saving money on commissions. These savings allowed Geico to charge less while still earning healthy profits. The lesson? When you can offer a product people need at the lowest price, you create loyalty and long-term success. Retail giants and the economy of scale. Consider Walmart, the undisputed king of low-cost retailing. Its strategy is simple. Buy in bulk to get deep discounts from suppliers, pass on the savings to customers, and move inventory quickly. This formula works so well because of what Warren calls monopoly buying power. A retailer like Nebraska Furniture Mart, another Buffett favorite, can buy massive quantities of goods at lower prices than smaller competitors. The manufacturers benefit too. Selling in bulk means higher overall profits, even with slimmer margins. These retailers don't just rely on their buying power. They often own their stores and the land beneath them. With no rent to pay, they keep costs low and profits high. Competitors looking to enter the market face nearly insurmountable barriers, from acquiring large retail spaces to building an inventory and competing on price. The furniture and jewelry connection. When Warren purchased Furniture Brands International, FBI, he saw the same principle at work. FBI dominated the furniture market by leveraging its low-cost production infrastructure and selling high-demand items like beds and couches at unbeatable prices. Similarly, Borsheims, a high-end jewelry store in Omaha, turned the jewelry business on its head by selling luxury items, gold, diamonds, rubies, at prices far below competitors like Tiffany's. Owner Ike Friedman kept costs down by operating out of a modest location and building trust with customers. People began flying into Omaha just to shop at Borsheims. When Warren bought Borsheims in 1986, it had already become the world's largest single high-end jewelry store. The secret? Lower profit margins, higher volume, and an unshakable reputation. The role of economies of scale. Low-cost producers like Mueller Industries, a maker of plumbing fittings and tubes, dominate their fields through economies of scale. By streamlining production and focusing on efficiency, they can undercut competitors while maintaining profitability. This advantage becomes even more pronounced during economic downturns. While competitors struggle, low-cost producers thrive because their margins allow them to stay competitive even in tough times. Why low-cost producers win? Warren discovered that low-cost producers and sellers share a few key characteristics that make them unbeatable. 1. Necessity. These companies sell products that people must buy: insurance, furniture, jewelry, plumbing supplies. 2. Scale and efficiency. By leveraging economies of scale, they produce and sell at lower costs than their competitors. 3. Barriers to entry. The upfront costs of competing with these giants are so high that new entrants rarely succeed. 4. Customer loyalty. Offering quality products at unbeatable prices creates trust and long-term relationships with customers. Lessons for investors. For investors, the appeal of low-cost producers is clear. Durable advantage. These businesses dominate their markets and are difficult to compete against. Steady demand. They sell products people need, ensuring consistent revenue. Resilience in downturns. Their low costs allow them to weather economic storms better than competitors. Opportunities in fear. As Warren has shown, the best time to buy into these businesses is during market downturns, when their true value is temporarily overlooked. As long as people need the basics of life, furniture, jewelry, plumbing, and insurance, low-cost producers will continue to thrive. Their secret is no secret at all. Sell essential products at the lowest price, and the world will come to your door. Warren Buffett's secrets for using the internet to beat Wall Street. The numbers kid. Warren Buffett has always been obsessed with numbers. As a child, he memorized license plate numbers, baseball card statistics, and city populations. He filled notebooks with numerical patterns and even calculated the lifespans of clergy members during church services. Numbers were his playground, and this early fascination eventually became the foundation of his investment genius. As he grew older, Warren's passion for numbers transformed into an obsession with financial statistics. He devoured annual reports, tax returns, and stock guides with an enthusiasm most reserved for novels. His favorite place in the world? His office, which he fondly calls his temple, where he immerses himself in the data that shapes his investment decisions. The daily information diet. Warren follows a strict regimen of financial reading. His daily reading list includes Wall Street Journal, New York Times, Washington Post, Los Angeles Times and Chicago Tribune, Fortune, Forbes, and Business Week. Industry trade publications like American Banker, Value Line Investment Surveys, and Moody's Stock Guides. Even in the digital age, Warren insists on having physical newspapers laid out for him in the evening. However, he also embraces the power of the internet for research. How Warren uses the internet for investing. The internet has made financial research infinitely easier, and Warren has adapted to this new landscape. Here are some of the key online services he relies on. Bloomberg Professional Service, Bloomberg.com, covers everything from stock and bond prices to economic indicators. Value Line Investment Survey, ValueLine.com, provides financial figures for over 3,500 companies with historical data spanning 15 years. Moody's, Moodys.com, and Standard & Poor's Stock Reports, StandardPoor.com, covering over 6,000 stocks. PRNewsWire.com offers up-to-date business news and annual reports for over 2,000 companies. SEC Edgar database /edgar.html. Provides crucial filings like 10Ks and 10Qs for all publicly traded companies in the US. MSN Money, msn.com, a free resource offering 10-year financial histories of thousands of companies. When researching a company, Warren compiles the most recent 10K and 10Q reports, annual and quarterly financial statements, the annual report, recent news and financial data from Bloomberg, Value Line, and Moody's. From these sources, he examines a company's return on equity, earnings trends, debt levels, share repurchases, and capital allocation strategies. No computer? No problem. Before Bill Gates gifted Warren a computer, he did everything the old-fashioned way. If you don't have a computer, you can follow Warren's early method. Visit your local library and access Value Line, Moody's, and Standard & Poor's reports. Call the company's shareholder relations department and request free copies of the annual report and 10K filings. Use the Guide to Business Periodicals to find magazine articles on the company. Read business publications like Fortune, Businessweek, Forbes, and Smart Money for industry insights. Many of these sources provide free information, which means you can conduct top-tier investment research without spending a dime. The circle of confidence? Warren often speaks of a circle of confidence. This means investing only in businesses he understands. For example, he admits that while Microsoft is a brilliantly run company, he doesn't fully grasp the tech industry's competitive landscape. If he can't determine a company's long-term advantage, he simply won't invest. To evaluate a company's durability, Warren asks, has this product been around for a long time? Will it still be relevant 10 years from now? Does the company have a durable competitive advantage? Is management acting in the best interest of shareholders? If a company meets these criteria, it's time for the next step. Scuttlebutt method. One of Warren's favorite investigative techniques is scuttlebutt, an approach pioneered by investment guru Philip Fisher. It involves gathering first-hand information by speaking to people directly involved in the industry. Snut. Warren personally calls competitors and industry insiders to ask questions. One of his famous scuttlebutt stories involves Geico. As a student at Columbia, he learned that his professor, Benjamin Graham, was the chairman of Geico. Determined to learn more, Warren traveled to Washington, D.C. and knocked on the company's headquarters door on a Saturday morning. Though the office was closed, a janitor let him in, leading him to Lorimer Davidson, Geico's chief investment officer. Davidson spent 4 hours explaining the insurance business, an encounter that led Warren to invest millions in Geico, an investment that later earned him over $1.6 billion. The Internet levels the playing field. In the past, this level of research took weeks, and the average investor had little chance of competing with Wall Street. Today, the Internet has leveled the playing field, giving everyone access to the same financial data Warren uses. Now, anyone can. Gather 10 to 15 years of financial data in minutes. Read company filings, earnings reports, and news instantly. Use scuttlebutt techniques to investigate companies. For the patient and diligent investor, the Internet is an incredibly powerful tool. Key takeaways. The Internet gives every investor access to the same financial data Warren Buffett uses. Start your research with the resources Warren trusts. Strollenberg.com, ValueLine.com, StandardPoorMoodys.com, PRNewsWire.com, sesi.gov/edgar.html. If you don't have a computer, libraries offer free access to valuable financial reports. Stay within your circle of confidence. Invest only in businesses you understand. Use the scuttlebutt method. Talk to insiders, competitors, and experts. Today's investor has unprecedented access to information. Use it wisely. By following Warren Buffett's approach, you too can leverage the power of financial information and the Internet to make smarter, more informed investment decisions. The tools are available. The question is, will you use them? Warren's checklist for potential investments. His points of light. Imagine standing on the deck of an old ship, peering over a treasure map. The map is detailed, showing where X marks the spot, but finding the treasure requires more than just a map. It demands knowledge of the terrain, the tools to dig, and the wisdom to recognize gold when you see it. Warren Buffett, the legendary investor, is that seasoned treasure hunter. His map? A checklist of proven principles. His treasure? Companies with a durable competitive advantage. A resilience that lets them thrive no matter the whims of the stock market. Warren has spent decades perfecting his ability to spot these companies, and today we're setting sail to learn from him. The importance of a good map. If you're looking for buried treasure, you'd better have a good idea where it's hidden before you start, Warren often reminds us. Investing without direction is like wandering the seas without a compass. To navigate the financial waters effectively, Warren discovered that businesses with specific traits often lead to gold. These traits reveal whether a company has what it takes to outlast the storms of competition and emerge stronger. The essence of Warren's strategy is preparation. Before the stock market offers you the chance to invest in a business, you must already know which companies are worth owning. That way, when chaos reigns and others are selling in panic, you can act with the confidence of a prepared investor. Building your knowledge base. Here's Warren's advice. If you truly want to invest like him, don't wait for the opportunity to appear. Instead, cultivate a working knowledge of hundreds of companies that meet his criteria for a durable competitive advantage. Know these companies so well that when the market offers them to you at a bargain, you'll recognize the opportunity immediately. Picture this. The stock market, Warren likes to say, is like a manic depressive neighbor named Mr. Market. Some days, Mr. Market offers you ridiculously low prices for a company, and other days, his prices are absurdly high. If you know what a business is truly worth, you can calmly buy when prices are low and sell when they're high, no matter how frantically Mr. Market behaves. The checklist. Warren's points of light. To help you get up to speed, we've compiled Warren's screening criteria, his points of light. These are the traits Warren looks for in companies, the ones that separate businesses with a durable, competitive advantage from those stuck in price wars and volatile markets. Along the way, we'll not only show you the types of businesses you should buy, but also the ones you should avoid. By the end of this journey, you'll have a clear template, a treasure map for building your own list of acquisition targets. A preview of what's to come. In the next chapter, we'll dive into Warren's 10 points of light, examining each one in detail. From understanding the power of strong brand loyalty to recognizing the protective moat of patents and cost advantages, you'll learn to see businesses through Warren's eyes. So grab your map and get ready to set sail. The treasure is out there. You just need to know where to look. Let's begin. The Tale of Two Companies, a lesson in the right rate of return on shareholders' equity. Once upon a time, in the bustling world of business and investments, a wise mentor named Warren embarked on a journey to uncover the secrets of durable competitive advantages. Warren had a keen eye for spotting companies that could stand the test of time, delivering wealth and growth to their shareholders. Over the years, he developed a reliable compass to guide his quest, a focus on companies with a consistently high rate of return on shareholders' equity. The foundation, understanding shareholders' equity. To understand Warren's method, let's first visit a small town where a young investor named Jane decided to buy her first rental property. Jane found a cozy house worth $200,000, putting down $50,000 of her savings and borrowing $150,000 from the bank. Her $50,000 investment was her equity in the property. Think of equity as the value you truly own, Warren once explained. It's like the difference between the total worth of something and what you owe on it. In the business world, companies present this information through balance sheets, financial snapshots showing assets, liabilities, and shareholders' equity. Jane's house, for example, had total assets of $200,000, its value, and liabilities of $150,000, the loan, leaving her with $50,000 in equity. The magic of returns. One day, Jane rented out her house, earning $15,000 a year. After paying $10,000 in expenses and taxes, she had a profit of $5,000. To measure how well her investment performed, she calculated her return on equity text return on equity, REQRP, net profit, shareholders' equity. For Jane, this was frac 5,000 equals 10%. Warren believed that a company's ROE was like a report card for its ability to use shareholders' investments to generate profits. But he didn't just look for any high number. Consistency was key. The tale of two companies. Imagine two businesses. Company 1, Company 2. Company 1 had a steady ROE of 18 to 25% over the years. Company 2 had an erratic ROE, sometimes reaching 15%, but often dipping below 10%. Warren would choose Company 1 without hesitation. Why? Because consistent ROE indicates a company with a durable competitive advantage, one that can navigate challenges and keep delivering results. Hunting for the gems. Warren's students learned to search for companies like Company 1 using tools like Value Line, Fortune's 500 list, and online stock screeners. They screened for businesses with ROEs above 12 cents, the historical average for American corporations. Anything below 12% hinted at a commodity-based business where competition eroded profits. Examples of companies that passed Warren's test included Coca-Cola, with an impressive 33% ROE when he invested, and Hershey Foods, around 16%. These businesses didn't just occasionally excel, they consistently delivered year after year. Opportunities in adversity. Even the strongest companies can face temporary setbacks. Imagine a business with a stellar ROE of 25% that suddenly dips to 10% during an industry downturn. The stock market, often driven by fear, might overreact, sending the company's stock price tumbling. Warren saw these moments as golden opportunities. If the company's competitive advantage remained intact, its ROE would likely recover, rewarding patient investors handsomely. The lesson: consistency equals durability. Warren's ultimate lesson was this: a company's ability to consistently generate high returns on shareholders' equity is a hallmark of durability. It signals that the business has a competitive moat, be it a powerful brand, efficient operations, or a unique product. Remember, Warren would say, the higher the ROE and the steadier its history, the stronger the company's shield against competitors. Armed with this wisdom, investors like Jane ventured into the stock market, searching for companies with high, consistent ROEs. They knew that behind those numbers lay the treasures Warren had spent a lifetime uncovering, businesses with the power to thrive, no matter the storm. And so their journey toward financial mastery began, guided by the simple, profound lesson of the right rate of return on shareholders' equity. The safety net. Understanding the right rate of return on total capital. In the small town of Capitalville, a curious investor named Ethan sought wisdom in the world of business. Ethan was fascinated by successful businesses, but often found himself puzzled by financial jargon. One day, he met a wise mentor named Warren, who taught him to look beyond surface-level numbers and into the true strength of a business. Ethan, Warren began, let me tell you about the safety net, what I call the right rate of return on total capital. It's the key to finding businesses with real, durable advantages. The trap of high shareholder returns. Warren leaned forward. Many people get excited when they see a company boasting high returns on shareholders' equity. But beware, sometimes those numbers are inflated because companies shrink their equity base by paying large dividends or buying back shares. This creates the illusion of profitability. He paused and asked, "Do you know why companies do this?" Ethan thought for a moment. "To attract investors?" "Exactly," Warren said. "But here's the trick. A high return on equity alone doesn't tell the whole story. That's why I focus on return on total capital, a measure of how much profit a business generates from all the money, both borrowed and invested, that it uses. A tale of two businesses. To illustrate, Warren told Ethan a story of two companies in Capitalville, General Motors and H&R Block. General Motors, Warren began, operates in a highly competitive market. Over 10 years, it showed a flashy average return on equity of 27.2%. But when I looked at its return on total capital, the number dropped to just 9.5%. That's a warning sign for me. Why? Ethan asked. because a low return on total capital reveals a lack of a durable competitive advantage. Contrast that with H&R Block, a company with a specialized service. It earned a consistent 21.5% return on equity and an almost identical 20.7% return on total capital. That consistency tells me it's a strong business. The magic number. Warren, what's the benchmark for return on total capital? Ethan asked eagerly. I look for at least 12% consistently, Warren replied. For example, Coca-Cola had an 18% return on total capital when I started investing in it. Nike hovered around 21%, and Yum Brands, which owns Taco Bell and KFC, was a standout at 30%. Financial companies, a different yardstick. What about banks and finance companies? Ethan inquired. Great question, Warren said. These businesses operate differently because they rely heavily on borrowing and lending. For them, I focus on return on assets instead of total capital. A return on assets above 1% is good, and anything over 1% is fantastic. If they also show a return on equity of over 12%, they're in excellent shape. The rare gems. Warren's eyes lit up as he shared one last insight. Sometimes a company is so powerful that it can pay out its entire net worth to shareholders and still thrive. Take Advo, a direct mail marketing leader. In 1996, it took on debt to pay shareholders a $10 per share dividend, wiping out its equity. Yet, its return on total capital remained an impressive 35%. Wow, Ethan exclaimed. So even without net worth, the company flourished? Exactly, Warren said. This only happens when a business has an exceptionally strong competitive advantage. Advo and Yum Brands are perfect examples. That's why I focus on a consistent return on total capital of 20% or more in such cases. The lesson Warren leaned back and concluded, Ethan, a consistently high return on total capital is like a safety net. It shows that a business has a durable competitive advantage and can thrive in any market condition. Always remember, consistency is key. Ethan nodded, feeling enlightened. Armed with this wisdom, he set out to analyze businesses with a sharper eye, ready to spot those hidden gems that promised enduring success. Key takeaways. High return on equity can be misleading. Look at return on total capital for a clearer picture. A consistent return on total capital of 12% or more signals a durable competitive advantage. For financial companies, focus on return on assets. Over 1% is good, 1.5% is excellent. Rarely, companies with exceptional earning power can thrive even after paying out their net worth. The right historical earnings, a story, and a lesson. Once upon a time, in the bustling town of Welshire, two entrepreneurs, Alex and Ben, ran their own businesses. Their journeys became a favorite story among aspiring investors because their earnings history painted two very different pictures. Alex ran a bakery called Golden Loaf. Year after year, his profits steadily grew. People loved his bread, not just for its taste, but because it was made using a secret recipe passed down through generations. Competitors tried to copy him, but no one could match his quality or customer loyalty. His earnings graph looked like a smooth upward slope, a testament to the durability of his competitive advantage. Ben, on the other hand, owned bargain bikes. His shop was at the mercy of seasonal trends and market whims. Some years, sales boomed. Other years, losses mounted as cheaper competitors flooded the market. Ben's earnings graph resembled a roller coaster with steep climbs and sharp drops, making his business unpredictable and vulnerable. A wise investor visiting Welshire would quickly recognize Alex's bakery as the more promising long-term investment. Why? Because consistent, upward-trending earnings signal that a business likely enjoys a durable competitive advantage, much like Alex's secret recipe and customer loyalty. But there's more to the story. When trouble strikes, one day Golden Loaf faced a setback. A key supplier abruptly went out of business, causing costs to rise and profits to dip. For the first time, Alex's earnings graph took a hit. Investors in Welshire panicked, selling off shares of the bakery at a discount. Across town, another bakery named Rapid Rolls had also experienced declining earnings. But unlike Alex's business, Rapid Rolls had no unique recipe, no loyal customer base, and no edge over its competitors. Its losses were part of a broader pattern of inconsistency, much like Ben's bike shop. Here's where the wisdom of legendary investor Warren Buffett becomes invaluable. Buffett would approach Alex's Bakery, Company C in our tale, with careful curiosity. He'd ask, is the dip in earnings a one-time issue or a sign of deeper problems? Can the supplier issue be solved? Is Alex's competitive advantage, the secret recipe and loyal customers, still intact? If the answers revealed that the problem was temporary and fixable, Buffett might seize the opportunity to buy shares in Golden Loaf at a discount, knowing its long-term value remained strong. In contrast, he'd likely avoid Rapid Rolls, Company D, where the decline reflected a lack of competitive edge and long-term durability. The moral of the story! When analyzing a company, always start by examining its historical earnings. Strong, upward-trending per-share earnings suggest a durable competitive advantage, like Alex's steady rise in bakery profits. Erratic earnings, like Ben's bike shop, often signal a business stuck in a price-competitive industry. However, even great businesses like Golden Loaf can face setbacks. When they do, take the time to investigate the cause. Is it a solvable, one-time problem, or does it point to a deeper issue? Buffett reminds us that the stock market sometimes overreacts, offering golden opportunities for those who are patient and diligent. But remember, if the investment doesn't make sense or the problem isn't clear, it's okay to wait. As Buffett says, the market is like a stream where occasional hunks of gold appear. When in doubt, take a step back, go out for a movie, and wait for the market to pitch you another ball. And so, Alex's Bakery became a beacon of investing wisdom, teaching generations of investors in Wealthshire and beyond the importance of right historical earnings. When Debt Makes Buffett Nervous, a story of wisdom and warning. Once upon a time, there was a wise investor named Warren. Warren had a knack for spotting extraordinary companies, those with what he called a durable competitive advantage. These were businesses so well positioned in their industries that they could thrive no matter the economic weather. But Warren also had a nemesis he constantly avoided: long-term debt. Warren often likened companies to houses. Imagine, he would say, that you own a home with a massive mortgage. If a financial storm hits, say, you lose your job, how would you keep up with those payments? The more debt you carry, the shakier your foundation. Companies are no different. A business burdened with excessive long-term debt is like that over-mortgaged homeowner, vulnerable to the slightest disruption. A tale of two companies. Let's compare two businesses, Wrigley's and General Motors. Wrigley's is a shining example of a company with a durable competitive advantage. In 1 year, its net earnings were so robust that they could wipe out its long-term debt entirely. Its strong financial footing allowed it to face any challenges with confidence. Now consider General Motors, GM. In 2000, GM carried $136 billion in long-term debt, a staggering amount compared to its $34 billion of total net earnings from the prior decade. If GM devoted every penny of its profits to paying off that debt, it would still fall short. A clear sign of trouble. The test of financial strength. Warren believed the best measure of a company's financial strength wasn't its assets, but its ability to pay off debt with earnings. A durable competitive advantage business like Wrigley's or Gannett could clear its debt within a few years of net earnings, leaving it nimble and resilient. Meanwhile, debt-heavy companies like GM or Ford were walking tightropes, dangerously exposed to economic downturns. Warren also avoided being lured by a high debt-to-equity ratio. Assets are like furniture in a sinking ship, he would say. It's the cash flow that keeps you afloat. The exception: banks and financial institutions. Interestingly, Warren didn't shun every business with significant debt. Banks, investment firms, and financial institutions naturally relied on borrowing. However, their debts were backed by diversified loan portfolios. As long as they maintained a high return on assets and managed risks well, Warren considered them solid investments. One of his favorite success stories was Wells Fargo. During a real estate downturn, Wells Fargo faced a storm of bad news, but Warren recognized its consistent profitability and snapped up shares at a bargain. The perils of overpaying. But even durable businesses could falter if they overreached. Warren shared the cautionary tale of Mattel, the toy giant. In 1999, Mattel acquired the Learning Company, paying an astronomical price with stock. The Learning Company, it turned out, didn't have a durable competitive advantage. The acquisition drained Mattel's resources and diluted its ownership, causing it to stumble financially. This taught Warren a vital lesson. Even a great company can make poor decisions. Paying too much for an acquisition or financing it with excessive debt was a recipe for disaster. Lessons for investors. 1. Focus on financial resilience. Companies with durable competitive advantages rarely carry long-term debt, exceeding 5 times their current net earnings. 2. Beware of acquisitions. Ensure the acquired company has a durable competitive advantage and avoid overpaying. 3. Stick to quality. When in doubt, Warren advises sitting and waiting for a better opportunity. A final thought. Warren often said, when the tide goes out, you see who's swimming naked. Companies with hefty debt and weak earnings are exposed when challenges arise. By investing in businesses with durable competitive advantages and sound financial health, you ensure that you and your portfolio are well prepared to weather any storm. And so, the wise investor continued to thrive, teaching others the timeless wisdom of caution and resilience in the face of debt. The Tale of the Razor and the Winning Product, a lesson in durable competitive advantage. Imagine you are a treasure hunter, not one chasing ancient gold, but one seeking a company worth investing in. A company with a product or service so valuable, so essential, that it stands out in the bustling marketplace. To find this treasure, you must follow a path of clues, and along the way, you'll learn about one of the most critical concepts in successful investing. The durable competitive advantage. The quest begins. Identifying the right company. Your journey starts with identifying companies that consistently earn high returns on equity and total capital, show steady growth in earnings, and are conservatively financed. These are the markers of a solid foundation. But the real treasure lies deeper. You must uncover whether this company sells a product or service that gives it an edge, a durable competitive advantage that keeps customers coming back, time and time again. Here's where you ask yourself, is this product or service essential to its customers? Does it hold a brand name reputation that businesses and individuals trust? To answer these questions, you'll need to don your detective hat. The product trail. Searching for the everyday essentials products often provide the easiest clues. Start by observing the world around you. Visit stores, study their shelves, and talk to the people who know these products best. Sales clerks, store managers, or even loyal customers. Ask them what products are must-haves for the store to operate. Which brands dominate the market in their category? Look for items that people buy repeatedly. Think toothpaste, coffee, or soft drinks, things used daily or frequently. A durable competitive advantage often lies in products that are indispensable to customers, consumed regularly, and easily recognizable by their brand names. Take a moment to consider King Camp Gillette, who revolutionized shaving. Inspired by the need for something disposable and frequently purchased, he invented the safety razor blade. By supplying millions of razors to soldiers during World War I, Gillette built a devoted customer base that needed his blades long after the war ended. His genius wasn't just in inventing the razor, it was in creating a product that ensured repeat sales, a hallmark of a durable competitive advantage. Hash the service trail. Digging deeper for durable services. Services are trickier to evaluate. Ask whether the service is indispensable to businesses or consumers. Is it something they can't easily live without? Examples might include that handle day-to-day financial transactions, media outlets like newspapers or advertising agencies that connect businesses with their customers, essential cleaning services for businesses. Durability in services often comes down to frequency and necessity. If businesses or consumers regularly depend on the service, there's a good chance the company providing it holds a competitive edge. The final test. Is it truly durable? Even when a company seems to have all the right markers, you must test its resilience. Examine its history. Has it sold the same product or service for years without needing significant changes? Does it rely on the same manufacturing or operational setup, keeping costs low while maintaining quality? Does the brand inspire trust and familiarity across generations? Durability is about consistency and trust. If your parents or grandparents used the product and it remains relevant today, you may have found a winner. Products like Coca-Cola, Hershey's chocolate, or Wrigley's gum have stood the test of time, making them icons of durable competitive advantage. The golden rule: frequency and repetition. The greatest treasures are products or services that are consumed frequently and require regular replacement. These are the razors, sodas, fast food, and newspapers of the world. They wear out or get used up quickly, creating a steady demand. This cycle ensures the company's profitability year after year. A final exercise: your own treasure hunt. Before you conclude your journey, put your newfound knowledge into practice. Visit a local store or mall, observe the shelves, and ask yourself, which products do people always need to buy? What brands are indispensable to the store's operation? Which items advertise so effectively that they're instantly recognizable? Write down your findings and research the companies behind these products. Check their financials, growth history, and competitive positioning. This hands-on exercise will sharpen your skills in identifying businesses with true durable competitive advantages. The lesson of the razor, a legacy of smart choices. The story of King Camp Gillette teaches us the power of understanding customer needs and creating a product that fulfills them repeatedly. Similarly, investing in companies with durable competitive advantages requires keen observation, research, and a commitment to understanding their place in the market. As Warren Buffett has shown, this disciplined approach can lead to remarkable results. So, treasure hunter, are you ready to uncover your next investment gem? The world is full of products and services waiting to reveal their secrets. All you need to do is look closely and think smartly. Happy hunting! The lesson of the striking pilots, a story of organized labor and investment. Once upon a time, there was an investor named Emily who prided herself on making wise decisions. She loved finding businesses with durable competitive advantages, companies that could weather storms, fend off competitors, and grow steadily over time. Emily's mentor, a wise old man named Mr. Warren, often shared stories to teach her the nuances of investing. One day, Emily stumbled upon a promising airline company. Its fleet of modern jets, bustling terminals, and strong brand recognition caught her eye. This might be it, she thought. But before making a move, she visited Mr. Warren for advice. "Ah, the airline business," Mr. Warren said with a knowing smile. "A fascinating industry, but have you considered the power of organized labor in this case?" Emily frowned. "What does organized labor have to do with my investment?" "Let me tell you a story," Mr. Warren said. He leaned back and began. Imagine an airline company with a shiny fleet of airplanes parked at an airport. These airplanes are incredibly expensive to own, maintain, and operate. Now, let's say the pilots decide they're unhappy with their wages and go on strike. What happens? Emily thought for a moment. Well, the airplanes can't fly, so the company stops making money. Exactly, Mr. Warren nodded. But here's the kicker. Those planes still cost money whether they're flying or not. Maintenance, financing, parking fees, it all adds up. The airline starts hemorrhaging money overnight. The management is backed into a corner. They can either meet the pilot's demands or risk financial disaster. Emily's eyes widened. That's a lot of power for the pilots to have. It is, Mr. Warren agreed, and it's not just airlines. Think about auto manufacturers. As soon as profits rise, unions often demand higher wages. If management refuses, the workers can strike, halting production. Suddenly, those profits turn into losses. Shareholders like you end up sharing the wealth with labor unions who act like demanding quasi-owners. Emily was intrigued. So is organized labor always a bad thing for investors? Not necessarily, Mr. Warren clarified. But it's a red flag in certain types of businesses. Companies with durable competitive advantages usually don't face this problem. They're often so profitable that they can pay their employees well and keep them happy, avoiding labor disputes altogether. He paused for a moment, then added, If you find a company with strong fundamentals, but a powerful labor union demanding an ever-growing slice of the pie, proceed with caution. That company might survive tough times, but it might not be the kind of investment you'd want to hold for decades. Emily nodded, understanding the lesson. So it's about balance, finding businesses that can withstand challenges without being held hostage by their labor force. Exactly, Mr. Warren said with a smile. The best investments are those where the company controls its destiny, not where it's constantly negotiating its survival. From that day on, Emily made it a point to consider the role of organized labor in every company she analyzed. She realized that investing wasn't just about numbers, it was about understanding the dynamics that could shape a company's future. And with Mr. Warren's wisdom as her guide, she built a portfolio of businesses that stood the test of time. The moral: be mindful of the influence of organized labor when evaluating an investment. In price-competitive industries with high fixed costs, labor strikes can cripple a company's profitability. Durable competitive advantage businesses, however, often have the strength to keep labor content while maintaining control over their financial destiny. Figuring out whether the product or service can be priced to keep abreast of inflation. Imagine you're running a business. Inflation starts creeping up, and soon the costs for raw materials, labor, and other inputs begin to rise. In a price-competitive industry, this can cause quite a problem. The challenge is simple. As your costs go up, you must either raise prices or risk losing money. But there's a catch. If you raise your prices too high, customers may not want to pay the new rates, and demand could drop. Take ranchers, for example. A rancher might be faced with the following dilemma. The price of cattle is dropping, but costs for feed, labor, fuel, insurance, and land are all going up. If the price of cattle drops too much, the rancher may not even cover the cost of production. With overproduction, the rancher might be forced to lower prices to try to sell everything. But this just creates a vicious cycle of losses. If they don't adjust their supply, they could face bankruptcy. Ranching, like many other industries, involves delicate calculations about how to balance supply and demand while staying profitable amidst rising costs. This dilemma also occurs in the airline business. Airlines have huge fixed costs: planes, fuel, labor, and maintenance. Then an event or price war comes along, forcing airlines to slash ticket prices to fill seats. The reality is that despite the enormous increase in operational costs over the years, planes, fuel, labor, airline ticket prices often decline because of competition. A round-trip ticket from Omaha to Paris that once cost $1,000 in the 1960s might now cost as little as $439 today. In the face of inflation, the airlines have been forced to lower their ticket prices just to stay in business. This is a tough spot for a business. Rising costs, coupled with falling prices, creates a situation where a company's ability to remain profitable becomes precarious. The durable competitive advantage and inflation. Now consider a different type of company, one with a durable competitive advantage. Warren Buffett believes that businesses with this advantage can increase the prices of their products in response to inflation without seeing a drop in demand. Companies like Nike, Coca-Cola, Hershey's, and Mattel are perfect examples. These brands have such strong reputations and customer loyalty that they can raise their prices as costs go up, and customers still keep coming back. Here's the fascinating part. Not only do these companies increase their prices, but they also see their profits rise as a result, which increases the overall value of the business. Let me show you with a simple example using Hershey's chocolate bars. The Hershey's example: how price increases lead to more earnings. Imagine it's 1980. Hershey's is selling 10 million chocolate bars. Each chocolate bar costs 20 cents to make, and Hershey sells it for 40 cents. The profit per bar is 20 cents. So if Hershey sells 10 million bars, the total profit is $2 million. Now fast forward to the year 2000. Inflation has doubled prices across the economy, so Hershey's chocolate bars now cost 40 cents to make, and the company charges 80 cents for each bar. The profit per bar is now 40 cents. Assuming Hershey still sells the same number of bars, 10 million, its profit has grown to $4 million. Here's where it gets interesting. Hershey still has the same 4 million shares outstanding, just as it did in 1980. So, the profit per share is now $1, because $4 million and 4 million shares equal $1 per share. In 1980, Hershey's stock was trading at a price-to-earnings P/E ratio of 15. So, if the company made 50 cents per share in 1980, its stock price would be $7.50 per share. 15 by 50 cents equals $7.50. In 2000, with earnings of $1 per share, the stock price would be $15 per share. 15 by $1 is 15. Despite the fact that Hershey sold the same number of chocolate bars and did not have to expand its operations, the company's stock price has risen as a result of its ability to increase prices along with inflation. This increase in stock price is due to the durable competitive advantage Hershey has. Its brand, product loyalty, and strong position in the market allow it to raise prices without losing customers. Why inflation isn't always a wealth-building tool. Now, don't get the wrong idea. Inflation in itself is not a wealth-building tool. If the cost of living doubles, you need to double the amount of money you have just to maintain your purchasing power. But businesses with a durable competitive advantage provide a unique opportunity for investors. They increase in value alongside inflation. In contrast, businesses that are price competitive may face the danger of rising costs coupled with falling prices, which leads to lower profits and a declining stock price. The difference lies in the company's ability to raise prices without sacrificing demand. The takeaway. In a nutshell, inflation is a challenge, but businesses with a durable competitive advantage can weather the storm. Their ability to increase prices without losing customers allows them to maintain or even grow their profitability during inflationary periods. For investors, these businesses represent inflation-proof opportunities, where the value of their investment can rise in tandem with the economy's inflationary pressures. For Warren Buffett, finding businesses with durable competitive advantages is key to successful investing, especially in a world where inflation is a constant threat. The tale of retained earnings, a lesson in durability. Once upon a time in the bustling world of commerce, there lived two kinds of companies. The first were the durable champions, businesses that had carved out a niche so strong and sturdy that rivals could barely dent it. The second were the price warriors, forever battling in a fierce arena where the lowest price ruled. One day, a wise old investor named Mr. Sage gathered a group of eager students to teach them how to spot the durable champions. "You see," he began, "not all businesses are created equal. The secret lies in how they handle their retained earnings, profits they choose to reinvest instead of paying out to shareholders. This is what fuels their growth." The students leaned in as Mr. Sage pulled out a book of tales featuring 4 companies: H&R Block, W. Wrigley Jr. Company, General Motors, and Bethlehem Steel. The tale of H&R Block. H&R Block, a durable champion, earned $1.06 per share in 1989. Over the next decade, the company retained $7.80 per share from its profits and transformed it into $2.56 earnings per share by 1999. "Imagine," said Mr. Sage, "a farmer planting seeds worth $7.80 and harvesting crops worth $1.40 every year. That's a return of 17.9%. This company didn't just maintain its field, it grew richer for its shareholders." The sweet success of Wrigley. Then there was Wrigley, another durable champion. In 1990, Wrigley started with $1 earnings per share. Over the next decade, it retained $9.55 per share and raised its earnings to $2.90 per share by 2000. "Now, here's the magic of chewing gum," Mr. Sage chuckled. "For every $9.55 the company reinvested, it generated $1.90 in annual income, a sweet return of 19.9%. The struggles of General Motors. "But not all stories have happy endings," Mr. Sage warned. Take General Motors, a price warrior. Between 1990 and 2000, GM retained a hefty $32.666 per share, but only managed to increase its earnings by $2.07. That's a mere 6.6% return. "These businesses fight daily battles in price wars," Mr. Sage explained. "Even with resources, their gains are modest, like trying to sprint through quicksand." The tragedy of Bethlehem Steel. Finally, Mr. Sage told the story of Bethlehem Steel, another price warrior. In 1990, it had earned 82 cents per share. Over the next 10 years, it retained $4.13 per share, but suffered losses that drained an additional $7.48 per share. Instead of growing stronger, Bethlehem Steel withered, Mr. Sage lamented. It's like planting seeds in barren soil. Not only does nothing grow, but the farmer ends up poorer than before. The moral of the stories, the students sat in silence, absorbing the lessons. Mr. Sage smiled and said, "If you had invested $1,000 in these companies in 1990, here's what you'd have by 2000. Wrigley, $566,666. H&R Block, $299,906. General Motors, $141,000. A loss, 40. Now, my dear learners, which stocks would you choose?" The students chorused, "The durable champions." Mr. Sage nodded. Indeed, these companies wield a 1-2 punch. They require less to maintain their advantage and use retained earnings to grow wealth. Price warriors, however, often exhaust their resources just staying afloat. A wise investor's checklist. But remember, Mr. Sage concluded, this is just one screen among many. Always ensure the numbers reflect a company's true earning power, and don't hesitate to investigate further if something seems unclear. A durable champion not only grows wealth, but also stands the test of time. As the students left, they felt ready to embark on their own investment journeys, armed with the wisdom of retained earnings and the stories of durable advantage. Can the company repurchase shares to the investor's advantage? A story of two businesses. Imagine two friends, Sarah and Michael, each owning a bakery in town. Sarah's bakery, Golden Crust, is known for its unique recipes that no one else can replicate, drawing customers in year after year. Michael's bakery, Daily Dough, competes on price, constantly offering discounts to keep customers coming. One day, Sarah decides to use the bakery's profits to buy back shares from some of her co-owners, leaving her with a larger ownership slice. Meanwhile, Michael finds himself struggling to pay bills and even has to sell more shares to bring in extra cash. Over time, Sarah's decision makes her remaining partners wealthier, while Michael's partners see their shares diluted and their profits dwindle. Why did this happen? The answer lies in the nature of the businesses and how share repurchases work. The magic of share repurchases. When a company buys back its own shares, it's like Sarah using bakery funds to buy out one of her partners. Initially, there were 3 partners, each owning 33% of Golden Crust. After Sarah buys one partner's share, the remaining 2 own 50% each. In the stock market, a similar thing happens. Imagine H&R Block. A real company, in 1990, had 106 million shares outstanding. Over the next decade, it bought back millions of shares, reducing the total to 97 million by 2000. Why does this matter? Because the company's profits, let's say $370 million in 2000, are now divided among fewer shares. Before share buyback, 370 million or 106 million shares equals 3.49 cents earnings per share. After share buyback, 370 million plus 97 million shares equals 3.81 earnings per share. Higher earnings per share, EPS, often lead to higher stock prices. For H&R Block, this meant its stock price rose from 52.35 to 57.15, all because of the share repurchase program. The shareholders who held on to their shares saw their slices of the profit pie grow larger, making them wealthier. The difference between durable and price-competitive businesses. Durable businesses like Sarah's Bakery generate steady and excess cash because they have an edge that competitors can't easily match. For example, H&R Block's durable competitive advantage allowed it to consistently buy back shares and enrich its shareholders. In contrast, price-competitive businesses like Michael's Bakery struggle to generate excess cash. Companies like Bethlehem Steel and General Motors from 1990 to 2000 couldn't afford to buy back shares. Instead, they issued more shares to raise money, diluting the ownership stakes of their existing shareholders. Warren Buffett's share repurchase strategy. Now, let's bring in Warren Buffett, a master of making share repurchases work for him. Buffett invests in companies with durable competitive advantages, businesses like H&R Block, Coca-Cola, and Geico. Then he encourages these companies to use their surplus cash to repurchase shares. Here's how it benefits him. 1. Suppose a company has 100 million shares outstanding and Buffett owns 10 million, 10%. 2. The company repurchases 40 million shares, leaving only 60 million outstanding. 3. Buffett's 10 million shares now represent 16.7% ownership, 10 were 60. Buffett didn't spend another dime, yet his ownership stake increased significantly. An example of this is Berkshire Hathaway's investment in the Washington Post. Buffett originally bought 10% of the Post for $10.2 million. Thanks to the Post's share repurchase program, Buffett's stake grew to 17.2% without him spending more. Today, that increased stake is worth hundreds of millions more than if the company hadn't repurchased shares. The lesson for investors. If a company you're investigating regularly buys back shares, it's a good sign it has a durable competitive advantage. These companies generate the excess cash needed for share repurchase programs, enriching their long-term shareholders. However, if the company is constantly issuing new shares, it might signal a cash-strapped business struggling to compete. Buffett's strategy is simple, yet powerful. Invest in companies with a durable competitive advantage and encourage them to repurchase shares. This way, you increase your ownership and wealth without lifting a finger. As Sarah's story showed us, having a durable business with a steady cash flow is the secret to ensuring that the pie, whether it's profits or bakery shares, gets divided into fewer, bigger, and tastier slices. The Tale of Two Companies, Berkshire Hathaway and General Motors. Once upon a time, in the bustling marketplace of investments, there were two prominent companies, Berkshire Hathaway and General Motors. These two businesses embarked on very different journeys, each holding a lesson about the power of retained earnings and their effect on market value. Berkshire Hathaway, the compounding machine. In 1983, Berkshire Hathaway was like a hidden gem, modestly boasting a book value of $975 per share while trading at $1,000 on the stock market. Under the visionary leadership of Warren Buffett, the company possessed a magical element, a durable competitive advantage. This competitive edge was fortified by a keen ability to allocate retained earnings wisely. Warren employed these retained earnings like seeds in a fertile field, reinvesting them into businesses with strong fundamentals and economic moats. Over the years, the company's book value grew exponentially, reaching approximately $40,000 per share in 2001. The stock price followed suit, soaring to $68,000 per share. This extraordinary growth demonstrated a powerful truth. When retained earnings are deployed effectively in a business with a durable competitive advantage, the company's intrinsic value and its stock price rise in tandem. Each dollar retained became a catalyst for wealth creation, compounding the net worth of the company and its shareholders. General Motors, the struggle for value. Meanwhile, General Motors, GM, a titan in the automobile industry, followed a different path. In 1983, GM's book value per share stood at $32.44, with a market price of $34 per share. By 2001, its book value had inched up to $36 per share, and its stock price had only managed to climb to $55. Despite retaining earnings for nearly 2 decades, GM's growth was tepid compared to Berkshire Hathaway's astronomical rise. Why? Unlike Berkshire, GM operated in a fiercely price-competitive industry, where retaining earnings did little to enhance the company's long-term economic value. Without a durable competitive advantage to shield it from market pressures, the company's retained earnings failed to generate significant growth in intrinsic or market value. The lesson: retained earnings are only as good as their use. The tale of these two companies highlights a critical principle. Retained earnings only add value when the company has the ability to use them wisely. A business with a durable competitive advantage can allocate retained earnings to ventures that enhance its net worth, leading to a corresponding rise in its stock price. Conversely, in price-competitive businesses, retained earnings often fail to create substantial long-term value. To spot companies like Berkshire Hathaway, Warren Buffett advises investors to look for specific traits. 1. Consistent returns. A high return on shareholders' equity, 12 plus, a high return on capital, and upward trending earnings signal a business with strong fundamentals. 2. Conservative financing. Durable advantage companies typically carry low long-term debt relative to their earnings. 3. Pricing power. The ability to raise prices with inflation indicates a robust economic moat. 4. Share repurchases. Companies that buy back shares increase the ownership stake of shareholders, often boosting long-term value. The Investor's Guide: How to Find Your Berkshire. To follow in Warren's footsteps, analyze a company's book value and stock price over a 10-year period. A durable competitive advantage is evident when both metrics show steady growth. When the market overreacts to bad news, presenting a temporarily low stock price, seize the opportunity to buy shares of these exceptional businesses. Above all, remember this: the magic of investing lies in patience. Once you've identified a company with a durable competitive advantage, hold on to it. Let its retained earnings compound over time and watch as the market eventually reflects the true underlying value of the business. Wouldn't you rather be driving a Berkshire? The story of spotting a bonanza in privately held businesses. Once upon a time, a young Warren Buffett uncovered a fascinating truth about privately owned businesses. Many of them, through the magic of regional monopolies or strong brand name products, had woven a durable competitive advantage into their operations. These advantages didn't just make the businesses successful, they made their owners immensely wealthy. What truly amazed Warren was that these private gems were often sold at a fraction of the price of their publicly traded counterparts. Unlike the stock market, which frequently demanded a premium for companies with solid track records, private businesses could often be purchased for just 4 to 6 times their pre-tax earnings. For Warren, this meant an immediate return on investment of 16% to 25% pre-tax, an almost unheard of yield in most markets. Though most of us aren't shopping for entire businesses, Warren's approach is valuable because he applies the same logic when buying fractional interests in publicly traded companies. Let's unravel his strategy step by step, the hunt for hidden gems. Warren's method wasn't to chase flashy startups or sprawling conglomerates. Instead, he sought out entrenched businesses with long successful histories. Often, these companies fell into 2 categories. 1. Brand name products, companies producing goods with strong consumer loyalty and growth potential. 2. Regional monopolies, businesses dominating a local market, with limited growth but a steady cash flow. Interestingly, these regional monopolies weren't attractive to larger corporations. Their limited growth potential made them less appealing. But to Warren and his investment vehicle, Berkshire Hathaway, they were treasures. Why? They were like AAA-rated bonds, offering stable cash flows that could be reinvested elsewhere. These bonds came with an added bonus: their returns could grow with inflation. The secret sauce, a unique competitive advantage. Many of the businesses Warren acquired were family-run enterprises with deeply rooted values and a strong attachment to their culture. These families weren't just selling a business, they were entrusting their legacy. Warren understood this and promised not to disrupt their culture, a gesture that made Berkshire Hathaway the buyer of choice. This softer human touch created a competitive edge. But it wasn't just the goodwill, it was the numbers that made these deals irresistible. Let's take a look at some real-life examples. Flash lessons in action: real deals, real returns. 1. Nebraska Furniture Mart, NFM. In 1983, Warren walked into Nebraska Furniture Mart, run by an indomitable woman named Rose Blumkin, or Mrs. B. When he told her he wanted to buy her store as a birthday gift to himself, she shot back with a price: $60 million. No negotiations, no accountants. Warren trusted her and wrote a check. Initial investment, $60 million. Pre-tax earnings, $14.5 million. There's 24% initial return. By 1993, pre-tax earnings grew to $21 million, 35% return on the original price. Mrs. B's business had a regional monopoly based on her reputation for low prices and an unbeatable selection. With vast retail and warehouse space, NFM crushed competitors with economies of scale. Warren realized that replicating this model would be nearly impossible for rivals. 2. See's Candy. Purchased in 1972, See's Candy was a well-loved brand in California known for its specialty chocolates. Price paid $25 million. Initial earnings for 16.8% return. By 1999, earnings ballooned to $74 million, a whopping 296% return on the original price. With its loyal customer base, See's grew steadily, outpacing inflation. Warren called it a sweet investment, and for good reason. Feckheimer Brothers, a uniform manufacturer, purchased in 1986 for $55 million, Feckheimer offered an initial pre-tax return of 24%. Though its growth aligned mostly with inflation, its steady earnings made it a reliable investment. 4. Scott Fetzer. In 1985, Warren bought Scott Fetzer, a company with a mix of brand-name products like Kirby vacuums and World Book encyclopedias. Price paid $320 million, pre-tax earnings $67.4 million, 21% return. Growth earnings rose to $92 million by 1995, delivering a solid return. Public companies turned private. Warren occasionally applied this logic to public companies. For example, Johns Manville, purchased in 2000 for $1.8 billion, it offered an initial pre-tax return of 19%, with earnings growing at nearly 9.5% annually. Acquired the same year for $1 billion, it yielded a 13.8% return, with earnings growth close to 9.7%. Why the whole cake tastes better? Tax advantages. Buying an entire business rather than a stake in a public company has a hidden benefit: tax efficiency. For example, if Berkshire bought 10% of a public company, dividends and capital gains would be taxed at every stage. But by owning the entire business, Berkshire could 1. Avoid dividend taxes. 2. Adjust the purchase price by adding retained earnings, reducing future capital gains taxes. This strategy saved millions over time, turning good deals into great ones. What you should remember: 1. Privately held businesses with durable competitive advantages can offer exceptional returns, typically 13.7% to 25% pre-tax. 2. These businesses often come with tax benefits that make them more attractive than buying minority stakes in public companies. 3. Warren's focus on trust, culture preservation, and fair pricing has turned Berkshire Hathaway into the preferred buyer for many family businesses. For the discerning investor, Warren's story teaches us this. Look for businesses with a moat, buy them at a fair price, and let their cash flows compound your wealth over time. It's a timeless lesson in patience, trust, and value. Warren's secret formula for selling at the market top. A story and lesson. Picture this. It's the late 1960s, and Warren Buffett, a young investor managing his partnership, is scanning the market with the same meticulous attention to detail that would make him a legend. Stocks are skyrocketing, with many trading at outrageous price-to-earnings PE ratios of 50 or more. It's a bull market frenzy, and everyone's piling in. But Warren does the unthinkable. He starts selling. Why? Because Warren doesn't invest based on the market's emotions. He invests based on business fundamentals. He understands when prices have disconnected from reality, and he has a plan for selling when the time is right. The secret formula for selling. Warren's philosophy for selling boils down to a few critical questions. 1. Does the company have a durable competitive advantage? 2. Is the market price high enough to outweigh future earnings potential? 3. Are there better opportunities elsewhere? Let's walk through some real examples to see how Warren applied these principles and why they work. The Great Sell-Off of 1969. In 1969, Warren recognized that the bull market had inflated stock prices far beyond their intrinsic value. Companies that historically traded at 10 to 25 times earnings were now at 50 times or higher. Warren knew that paying too much for even the best business was a losing game. Instead of chasing overpriced stocks, Warren told his investors he was stepping away from the market entirely. Sure enough, by 1973-74, the market crashed, and those same stocks plummeted to single-digit PE ratios. Lesson 1. When value-oriented investors start leaving the game, it's often a sign the market has bubbled. The Coca-Cola dilemma of 1998. Fast forward to 1998. Coca-Cola was a crown jewel in Berkshire Hathaway's portfolio, with a durable competitive advantage and a solid 12% annual earnings growth rate. But something was off. Coke's stock price had soared to 62 times its earnings. Warren calculated that over the next decade, each share of Coke would generate $24.88 in earnings. Yet at $88 per share, it was clear that investors were overpaying. A corporate bond paying 6 pence could generate $52.80 over the same period, double the return. Warren knew it was time to sell, but he didn't just dump his shares on the market. Instead, he orchestrated a brilliant deal. He swapped overpriced Coke shares and others for General Reinsurance, a company loaded with $19 billion in bonds. The deal was tax-free, meaning Warren avoided paying billions in capital gains taxes while converting overvalued stocks into cash-rich assets. Lesson 2. Compare a stock's future earnings to alternative investments like bonds. If the bond pays more, it's time to sell. When the business changes. Even durable competitive advantage companies can lose their edge if their environment shifts. Take Freddie Mac, for example. Initially, Freddie Mac was in the safe business of securitizing single-family home mortgages, but when it ventured into riskier commercial mortgages, Warren sold his shares. Why? Because he understood that this change introduced risks that could destabilize the business. Lesson 3. Keep an eye on the horizon. If a company's business model shifts or its competitive advantage erodes, it might be time to sell. When a target price is met, sometimes the math dictates a sale. In 1981, Warren spotted a mispriced opportunity with Tenneco Offshore. The company was converting to a partnership, which meant it could pay out more earnings to shareholders. Despite this, the market undervalued it. Warren bought in at $5.71 per share, knowing the stock was worth $8. After the conversion, the market caught on and the price rose. Warren sold, locking in a tidy profit. Lesson 4. When a stock hits your target price, don't hesitate to sell. Key takeaways. Warren's secret formula for selling isn't about timing the market. It's about understanding the underlying value of a business and making rational decisions when prices deviate from reality. 1. Hold great businesses for the long term, but don't be afraid to sell when the price gets irrationally high. 2. Always compare potential returns from stocks to alternative investments like bonds. 3. Watch for changes in a business or its environment that might erode its competitive advantage. 4. Set a target price based on the company's intrinsic value and stick to it. By following these principles, Warren has repeatedly turned overpriced assets into cash-rich opportunities, growing his fortune while avoiding the pitfalls of speculation. And now you can too. Remember, investing isn't about chasing the highs, it's about making thoughtful, business-like decisions that stand the test of time. The tale of Warren Buffett's investing wisdom. Once upon a time in the bustling markets of finance, there lived an investor named Warren Buffett, often called the Oracle of Omaha. His investments were legendary, not because he chased the excitement of fast-moving stocks, but because he sought the quiet strength of companies with a durable competitive advantage. Warren had a method, a timeless one, that he refined over decades. His investment choices often made people wonder, why that company? But Warren's answer was simple. The key isn't the company, it's the price you pay for it. The first list. 1998 to 2001 investments. Between 1998 and 2001, Warren, either through his company Berkshire Hathaway, his personal portfolio, or his foundation, carefully invested in a handful of businesses. These were companies that, in his eyes, had strong competitive moats, brands, economies of scale, or unique offerings that kept competitors at bay. They were selected because they stood tall through the tides of economic changes. But Warren would be the first to warn you. Just because I invested in them then doesn't mean I'd buy them now. Why? Because for Warren, the price was the ultimate arbiter. If the price was right, he would strike. If not, he would wait, sometimes for years, like a patient hunter. The second list, a 30-year legacy of learning. The second list isn't just a record of investments, it's a treasury of lessons. Over the last 30 years, Warren made investments that taught the world how to think long-term. Companies in this list were more than numbers on a balance sheet. They were examples of businesses with predictable earnings, steady growth, and the resilience to weather economic storms. Imagine a company as a tree. Warren didn't care about how tall it was today. He cared about how deep its roots were. These investments had roots that went down to the bedrock, ensuring they would stand strong against any storm. The philosophy of patience. One of Warren's favorite parables was about Mr. Market, a fictional character who represents the stock market. Mr. Market has moods, sometimes wildly optimistic, pricing businesses far above their true value, and other times deeply pessimistic, selling them for less than they're worth. Warren's advice? Wait for the pessimistic days. That's when Mr. Market, in his gloom, offers bargains that can make fortunes for the patient investor. But it takes discipline to ignore the noise of optimism and focus on intrinsic value. Your toolkit for investing. Warren often spoke about using the tools available to every investor. 1. Company websites. Almost all businesses have comprehensive websites where you can find annual reports and updates. 2. Seek filings. The SEC's EDGAR database, c.gov/edgar.shtml, is a treasure trove of 10K filings containing detailed financial and operational data. 3. Value Line and MSN Finance. These platforms provide historical financial data, helping investors see trends and make informed decisions. The final lesson? Patience pays. Before Warren sat down for any investment, he asked himself a simple question. Am I ready to wait? Great opportunities don't knock every day, but when they do, they're like rare gems. You might have to wait for years, but the reward can be life-changing. So as you embark on your journey to invest like Warren Buffett, remember, find companies with durable competitive advantages, study their fundamentals, and wait. Your moment will come when the price is right. Bon appetit and happy investing. The art of value investing, lessons from recent investments. Investing is as much about patience and discipline as it is about numbers. Great investors, like Warren Buffett, look beyond market noise and focus on value, purchasing businesses, not just stocks. Let's explore some of his recent investments and extract valuable lessons from each. 1. Aegis Realty, AER, the power of dividends. Aegis Realty, a real estate investment trust, owns and manages 3 million square feet of shopping center space. With a dividend payout of 96 cents per share and a book value of $14.81 per share, it was an attractive play when Buffett acquired it in 2000 at $9 per share. Lesson: dividends provide a safety net. Even if the stock stagnates, a 10% return through dividends ensures steady income. Buying below book value offers a margin of safety, a core principle of value investing. Chapter 2. Dun & Bradstreet Corp., DNB. Unlocking Hidden Value. DNB, a business information provider, was an undervalued gem when Buffett invested in 1998. His timing was strategic. It was about to spin off Moody's Investors Services, a lucrative business. The market initially overlooked the true value of this division, creating an opportunity. By 2001, Buffett's $15 investment in DNB had returned a staggering $44. Lesson: spin-offs can be hidden treasures, often undervalued by the market. Patience pays off. While others chased tech stocks, Buffett stayed true to fundamentals. 3. First Data Corp., FDC. The power of transactions. Credit card transactions power the modern economy, and First Data Corp. Processes millions of them daily. Buffett took advantage of a market panic in 1998 to buy in at $20 per share. With earnings of $156 per share and a consistent 15% annual growth rate, the stock later soared to $66. Lesson: buy when others are fearful. Panic sell-offs create golden opportunities. Look for durable businesses. Financial transactions aren't going anywhere. 4. Furniture Brands International, FBN. Buying the market leader. The leading manufacturer of residential furniture and furniture brands was another post-bubble purchase in 2000 at $14 per share. With strong earnings growing at 28% annually, the stock rebounded quickly, reaching $25 by early 2001, a 7% return. Lesson: market downturns create buying opportunities. Great businesses don't stay down for long. Invest in market leaders. Dominant players often recover faster. Chapter 5. GPU Inc., GPU. Investing in Essentials, GPU, a utility company serving millions of customers, faced financial struggles due to energy cost increases. Buffett bought in $2,000 at $25 per share, knowing that regulators would likely step in to ensure the company's survival. As expected, a buyout offer from First Energy soon followed at $36 per share. Lesson: regulatory environments matter. Essential services often receive government support. Crisis investing requires foresight. Buffett recognized that electricity providers rarely disappear. Now 6. Johns Manville. From bankruptcy to billion-dollar buy. Once a great company, Johns Manville was crippled by asbestos litigation. By 2000, the market ignored its strong non-asbestos business, allowing Buffett to purchase the entire company for $1.8 billion, securing a 19% initial return. Lesson: distressed assets can be gold mines. Look beyond past troubles. Evaluate true earnings potential. Lawsuits scared investors away, but the core business remained solid. Number 7. Justin Industries. The power of brand loyalty. Acme Bricks and Tony Lama Boots, both part of Justin Industries, are trusted American brands. Buffett bought the company for $570 million, earning a pre-tax return of 8.9%. With a history of 16% annual growth, it outperformed Treasury bonds. Lesson: brand power drives value. Trusted names withstand market cycles. Long-term earnings growth beats short-term volatility. And Hasher 8, La-Z-Boy Inc., LZB. Buying when others panic. Buffett acquired La-Z-Boy in 2000 at $14 per share after a market crash. By mid-2001, the stock had already climbed to $19, demonstrating the potential of buying during downturns. Lesson: market crashes are opportunities, not threats. Simple, well-run businesses offer great returns. Hasher 9. Nike Inc., NKE, investing in global giants. Nike, the world's leading sports shoe company, traded below $30 in 1998 and 2000 due to temporary downturns. Buffett saw this as a chance to buy into an iconic brand. Lesson: global dominance ensures long-term value. Short-term challenges create entry points. 10. USG Corp. USG, betting on recovery. Asbestos lawsuits and falling wallboard prices sent USG stock from $45 to $10. Buffett bought aggressively, even as the company declared bankruptcy. Lesson: troubled companies can recover if their core business is strong. Be greedy when others are fearful. Har 11. Yum Brands. Yum. Fast food, fast growth. Buffett invested in Yum Brands, KFC, Pizza Hut, Taco Bell in 2000 at $24 per share. By 2002, it had doubled to $55, proving the resilience of fast food. Lesson: consumer staples are recession-proof. Recognize value in everyday businesses. Final thoughts. What can we learn from Buffett's approach? Buy when others panic. Market downturns create opportunities. Seek undervalued businesses. Buying below intrinsic value reduces risk. Focus on strong brands and durable industries. Economic slowdowns don't eliminate demand. Be patient. Value investing isn't about quick wins, it's about long-term gains. Buffett's success isn't magic, it's methodical. By studying his investments, we can learn to see the market as he does, not as a casino, but as a place to buy great businesses at fair prices. Happy investing! Historical Investments 1. Lessons from Warren Buffett, The Art of Value Investing. Warren Buffett, the Oracle of Omaha, has long been revered for his keen eye in spotting undervalued companies with durable competitive advantages. His investments are not just about numbers, but about understanding businesses, their management, and long-term potential. Let's explore some of his historical investments and the lessons they teach us about value investing. Amerada Hess, AHC, The Value of Assets. Buffett's investment in Amerada Hess was a textbook case of asset evaluation. He multiplied the price of oil by the barrels in the ground and realized the stock was significantly undervalued. Buying at $26 per share and selling at $50 within a year, he demonstrated the importance of buying assets at a discount. Lesson: look beyond earnings. Sometimes raw assets hold immense value. American broadcasting companies, ABC, buying in a downturn. During an advertising recession in 1978, Buffett saw an opportunity. ABC had one of the strongest competitive advantages in television, yet its stock was cheap. He bought at $24 per share and sold at $40 just 2 years later. ABC later merged with Capital Cities and then Disney. Lesson: Economic downturns create buying opportunities in strong businesses. American Express, AXP investing in people and brand power. Buffett first invested in Amex during the infamous salad oil scandal when its reputation took a hit, but its core business remained strong. Later in 1994, under CEO Harvey Golub, Amex regained focus, prompting Buffett to buy at $26 per share. He also received Lehman Brothers stock via a spin-off, creating an instant 15% return. Today, Amex trades over $166. Lesson: buy into strong brands with capable leadership, especially when they face temporary setbacks. Anheuser-Busch, the strength of brand loyalty. With dominant beer brands like Budweiser and Michelob, Anheuser-Busch had a lasting competitive advantage. Buffett recognized that people order beer by brand, ensuring loyalty. The company maintained strong earnings growth and excellent returns on capital. Lesson: brand loyalty creates long-term profitability and stability. Bristol-Myers Squibb BMY, durable demand in pharmaceuticals. Buffett purchased shares in 1993 amidst fears of government regulation. With a history dating back to 1887 and a steady demand for pharmaceuticals, the company was a safe bet. His investment at $13 per share, with earnings of $1.10, provided an average annual return of 23%. Lesson: essential industries like healthcare provide long-term security. Campbell Soup, CPB, simple, timeless products. Campbell's 70% market share in condensed soup gave it an undeniable advantage. With additional brands like V8, Swanson, and Pepperidge Farm, its dominance was clear. Buffett saw value in recession-resistant companies, knowing that demand for soup remains steady. Lesson: look for companies with simple, enduring products. Capital Cities Communications, the power of media. Buffett initially owned Capital Cities in the late 70s, but sold too early, a mistake he later corrected. When Capital Cities acquired ABC in 1986, Buffett invested $515 million at $17.25 per share. When Disney later bought Capital Cities in 1995, he exited at $127 per share, earning a 24% annual return. Lesson: recognize the value of strategic acquisitions and long-term holding. Coca-Cola, the ultimate competitive advantage. Coca-Cola is one of Buffett's most famous and profitable investments. With a 50% global market share in soft drinks, Coke exemplifies a durable competitive advantage. Buffett emphasized buying during recessions, but never overpaying. Lesson: strong global brands with emotional connections to consumers are golden. Disney, DIS, undervaluation and long-term holding. In 1966, Buffett bought Disney when its market cap was just $80 million, less than the value of its film catalog. He sold too soon, missing out on billions. He later re-entered with 21.5 million shares when Disney acquired Capital Cities in 1995. Lesson: recognize when a company's assets are worth more than their stock price. Exxon, XOM, investing in necessities. During the early 80s recession, Buffett saw an opportunity in Exxon. Oil demand remained high despite economic struggles. At $44 per share, it had a 15.2% initial return, growing steadily to $87 by 1987, yielding an annualized return of 25%. Lesson: essential commodities maintain demand even in downturns. Freddie Mac, knowing when to exit. Freddie Mac, a leader in mortgage-backed securities, was once a Buffett favorite. However, as it became riskier, he exited. This decision proved wise when the company later faced financial troubles. Lesson: strong businesses can lose their edge. Know when to walk away. Gannett, GCI, newspapers as a monopoly. Buffett invested in Gannett, America's largest newspaper publisher, during an advertising recession in 1994. Buying at $24 per share, it later traded at $76, providing a 15.2% annual return. Lesson: local monopolies like newspapers provide consistent profits. Geico, the crown jewel. Buffett's biggest early success was Geico. Initially on the brink of insolvency, Buffett believed its competitive edge in direct insurance sales would prevail. His $45 million investment grew to $2.3 billion in 15 years, a 29.9% annual return. Lesson: a struggling but fundamentally strong company can be a gold mine. Warren Buffett's investments highlight key principles of value investing. Buy when others are fearful. Market downturns create opportunities. Invest in strong brands with loyal customers. Coca-Cola and American Express prove this. Look at management quality. The right leadership can turn a company around. Understand the business model. Durable competitive advantages ensure long-term success. Know when to sell. Freddie Mac's increased risk showed Buffett's discipline. By following these principles, investors can build wealth just like Buffett, one smart decision at a time. Historical investments too, lessons from the masters. In the grand theatre of investing, some names echo through time, their legacies built on keen insight, patience, and an uncanny ability to see value where others saw noise. Warren Buffett is one such name, a man who didn't just invest in companies, but in their futures. His choices teach us invaluable lessons about identifying durable businesses, timing investments, and recognizing the power of compounded returns. Let's take a journey through history and unpack the wisdom behind some of the most iconic investments. 1. General Electric, the powerhouse of electrification. A century ago, electricity was a luxury. Then came General Electric, GE, the company that wired the planet and made fortunes along the way. With high returns on equity, 18 to 23%, and total capital, 16-25%, it became a behemoth. Yet even Buffett, an admirer of GE, found its price often too steep. The lesson? A great company doesn't always make a great investment. Price matters. GE at a PE above 30 was a bubble, but below 15, it became a golden opportunity. 2. General Foods, the sweet taste of a 21% return. In 1979, Buffett spotted a tasty deal in General Foods, acquiring shares at $37 when earnings were 5 and 12 per share. His calculated bet paid off when Philip Morris saw the same value and bought out the company for $120 per share. The takeaway? Strong earnings growth and brand strength make a business attractive, not just to investors, but to acquirers willing to pay a premium. Hab 3. Gillette, a cut above the rest. Razors dull, batteries drain, but Gillette's business model remained sharp. With a return on equity above 30% and earnings growing at 14% annually, it was a textbook example of a consumer staple with recurring demand. The catch? Even great businesses can be overpriced. A PE of 40 during the 1999 bubble was too high, but below 15, it was a steal. Patience is key. Nasha 4. Hershey, the chocolate fortress. Warren Buffett often used Hershey as a model for durable competitive advantage. The company dominated the chocolate industry, protected by a trust that limited takeovers. High returns on capital and steady earnings growth, 9.9%, made it a sweet investment, but Buffett waited for the right price, below a PE of 15. Lesson? Even irresistible brands must be bought at the right value. Ha5 Interpublic Group, the invisible gold mine. Advertising agencies like Interpublic are unique. They profit as businesses grow. Buffett recognized this in 1974 when he scooped up shares at $7.65. By 2001, those shares, adjusted for splits, would have been worth $2.8 billion, a 27% compounded return. The lesson? Industries with scalable, low-capital businesses can generate immense wealth. Hammer 6. McDonald's, a tasty investment. McDonald's turned the burger into a global empire. With a return on equity of 16 to 20% and earnings growing at 12%, Buffett saw its long-term potential, buying at $20 per share in the mid-90s. When the market overheated, he exited at $30 to $45 per share. The strategy? Buy when undervalued, sell when exuberance takes over. Hash 7. Walmart, the retail giant. Walmart's strategy of low prices and high volume made it the king of retail. Its return on equity exceeded 20%, and earnings grew at 24% annually. Buffett acquired shares in 1997, knowing its economies of scale created a moat. The takeaway? Companies with cost advantages and operational efficiencies tend to dominate their industries. Dash 8. Washington Post, the power of patience. Buffett bought Washington Post shares in 1973 for $5.69 when earnings were 76 cents per share. With a dominant market position, its value soared, crossing $500 per share decades later. The lesson? Buying quality assets during downturns can yield spectacular returns over time. 9. Wells Fargo, Banking on cycles. Buffett entered Wells Fargo during a banking crisis when fear drove the price down to $17 per share. Recognizing the cyclicality of banking, he held on as the stock rebounded. The moral? Industry downturns often create buying opportunities for fundamentally strong businesses. 10. Warner Lambert, a lesson in brand strength. Owning Listerine, Trident and Advil, Warner Lambert boasted a return on equity above 30%. Buffett eyed it at a PE of 13 when regulatory fears loomed, but exited when he couldn't build a meaningful stake. The insight? Even great companies may not fit an investor's strategy if ownership influence is limited. Key takeaways from Buffett's playbook. Buy when others panic. Buffett often purchased when the market was fearful. Wait for a fair price. Even great companies can be overpriced. Look for durable competitive advantages. Brands, moats, and strong management matter. Understand the business model. Know how the company makes money and whether it is sustainable. Be patient. The best returns often come from holding quality investments long term. Buffett's investment philosophy is a masterclass in patience, value, and strategy. By studying his moves, we can uncover timeless principles that apply to any market cycle. The past teaches us that true wealth isn't made in chasing trends, but in understanding businesses and waiting for the perfect pitch. Warren's best-kept secret, the power of stock arbitrage. It was the early 1950s, and a young Warren Buffett sat in the office of Benjamin Graham's investment firm in New York. Papers were strewn across his desk, numbers scrawled across yellowed pages. He was poring over merger announcements, trying to unravel one of Wall Street's best-kept secrets, stock arbitrage. At the time, most investors chased long-term growth. But Warren had discovered something different, an investment strategy that could generate steady, low-risk returns even in turbulent markets. Graham's firm had been using it for decades, producing an enviable annual return of 20%. Buffett, always the eager student, knew he had stumbled onto something powerful. The hidden gold mine of arbitrage. Stock arbitrage, or what Warren calls workouts, is an investment strategy based on corporate events, mergers, spin-offs, buyouts, and takeovers. The concept is simple. When a company announces that it will be acquired, its stock price often trades below the final buyout price. The arbitrageur buys the stock at the lower price, then sells it later at the announced buyout price, pocketing the difference. For example, if Company Y announces that it will buy Company X for $120 per share, but X's stock is still trading at $100, an investor can buy in at $100 and make a nearly guaranteed $20 per share once the deal closes. The key variable? Time. The faster the deal closes, the higher the annualized return. The evolution of arbitrage from newspapers to the internet. In Buffett's early days, arbitrage was a full-time job. He would sift through 5 or 6 newspapers a day, hunting for merger announcements. Once he found a promising deal, he had to carefully track it to ensure no last-minute surprises, such as regulatory roadblocks or buyer withdrawals, would ruin his investment. Back then, stock trading commissions were high, making this game almost exclusively for institutional investors. Fast forward to today, and everything has changed. With the advent of online trading, individual investors can execute trades for pennies. Websites like Mergerstat.com and Money Central provide up-to-the-minute lists of mergers and acquisitions, eliminating the need for hours of research. What once took Buffett days now takes minutes. How Buffett used arbitrage to win even in bear markets. During the early years of the Buffett partnership, 1957 to 1969, arbitrage played a critical role. In 1962, when the stock market tanked and the Dow dropped 7.6%, Buffett's arbitrage investments helped his partnership rise 13.9%. While his regular stock investments lost money that year, the profits from arbitrage turned potential disaster into a financial triumph. Even in his later years, Buffett has continued using arbitrage. In 1988, he bought over 3.3 million shares of RJR Nabisco when management announced plans to buy out shareholders. When a bidding war erupted, Buffett cashed out with a hefty profit. How you can get started? Want to follow Buffett's playbook? Here's how. Find merger deals. Use free resources like mergerstat.com and MSN Money Central to find publicly announced mergers where a company is being acquired for cash. Calculate the spread. Determine the difference between the current stock price and the buyout price. This spread represents your potential profit. Assess the time factor. The sooner the deal closes, the higher your annualized return. A deal that closes in 6 months at a 10% gain yields a 20% annualized return. Confirm the deal's status. Call the acquiring company or read SEC filings to ensure the deal is progressing as planned. Diversify to mitigate risk. Buffett always invested in multiple arbitrage deals to spread risk. If one deal falls through, others can still generate profits. A word of caution. Buffett has one hard rule: never invest based on rumors. Wall Street often speculates about potential mergers, but Buffett only bets on deals that have been publicly announced. While speculating on takeovers can bring massive returns, it also carries enormous risk. Final takeaways. Arbitrage helped Buffett generate consistent returns, even in bear markets. Online trading has made arbitrage accessible to individual investors. Always invest in publicly announced deals, not rumors. Diversification is key to managing risks in arbitrage investing. Stock arbitrage may not be the most glamorous strategy, but as Buffett discovered, it's one of the best-kept secrets to building wealth. And now, with modern tools at your fingertips, you have the same opportunities that once took Buffett hours of meticulous research to uncover. The question is, will you take advantage of them? Warren Buffett's mathematical equations for uncovering great businesses. The art of investing the Buffett way isn't about chasing trends or gambling on market movements. It's about understanding the fundamental value of a business. Buffett has long championed the strategy of finding a company with a durable competitive advantage, then patiently waiting for the perfect buying opportunity. These opportunities often present themselves during recessions, market corrections, panic sell-offs, or temporary company-specific issues. The goal is simple: buy a great business at a price that makes business sense. The power of price, why it matters. Many investors believe that if they are buying an excellent business for the long haul, the price they pay is of little concern. Nothing could be further from the truth. Price dictates returns, and a miscalculation can mean the difference between compounding wealth at an extraordinary rate or earning just an average return. Consider the case of H&R Block. In 1991, H&R Block stock traded between $19 and $38 per share. By 2001, the stock price had risen to $80 per share. Let's examine two possible investment scenarios. Buying at $19 per share. If you invested $100 in 1991, your annual compounding rate of return would have been 15.4%, growing your investment to $418.49 by 2001. Buying at $38 per share. If you invested $100 in 1991, your annual compounding rate of return would have been 7%, yielding a final value of $209,969 in 2001. That's a $208,808 difference, all because of the purchase price. Pay less, earn more. Pay more, earn less. Buffett's tool of choice, the financial calculator. To assist in making these calculations, Buffett himself uses a financial calculator, and you should too. A simple model like the Texas Instruments BA35 Solar can quickly compute the compounding annual rate of return for any investment. Here's how to do it. 1. Your calculator's in financial mode, fin on the screen. 2. Enter the purchase price, $19, as the present value, PV. 3. Enter the holding period, 10 years, as end. 4. Enter the selling price, $80, as the future value, FV. 5. Press CPT, compute, and then I% interest rate. 6. The calculator will display a 15.4% annual return. Buffett's rule for price. Buffett's philosophy is straightforward. You want to pay the lowest price possible because it will determine your compounding rate of return and ultimately your wealth. Getting started, the data you need. Before running any calculations, you need to gather essential financial data about the company you're analyzing. This includes current income statement, current balance sheet, per-share earnings for the last 10 years, return on equity, ROE figures for the last 10 years. Once you have this data, you can start using Buffett's intrinsic value equations to evaluate whether the company has a durable competitive advantage and how strong it is. Whether the company's stock is selling at a price that makes business sense, which usually happens when there's a temporary market or company-specific downturn. Conclusion: the Buffett way. Investing, like Warren Buffett, isn't about chasing the next big thing. It's about finding great businesses at the right price. By using the right mathematical tools, waiting for the right price, and understanding the power of compounding, you can significantly increase your long-term returns. Buffett's strategy is a marathon, not a sprint. The patience to wait for the right price and the discipline to invest only in businesses with a durable competitive advantage are what separate billionaires from millionaires. Master the math, trust the process, and watch your wealth grow. The predictability principle, Warren Buffett's first equation, a lesson in earnings from Warren's office. It was a crisp autumn afternoon, and young Michael sat across from Warren Buffett in his modest Omaha office. Michael, a budding investor, had spent months reading about value investing, but still felt lost when it came to identifying great companies. Warren leaned back in his chair, a warm smile playing on his lips. "Michael," he began, "if you don't know where a company's earnings are headed, how can you possibly know if it's worth investing in?" Michael hesitated, then shook his head. "I guess you can't." "Exactly. That's why predicting earnings at a glance is the very first financial equation you need to master. The simplest test in investing." Warren reached for a financial report from his desk. "Take a look at this," he said, pointing to a column of numbers. "This is a company's earnings per share over the last 10 years. What do you notice?" Michael scanned the numbers. They had a steady upward trend, except for one small dip in year 6. "It looks stable," he said. "Mostly increasing." "Good," Warren nodded. "Now look at this one." He slid another report forward. This time the numbers bounced around. High one year, low the next, then a sudden spike followed by a crash. "This looks like a roller coaster," Michael frowned. "Exactly," Warren said. "The first company is one I'd consider. The second, not so much. See, if earnings are unpredictable, how can you trust what the future holds? And if you can't trust the future, you can't make a smart investment. The 4 types of earnings situations." Warren stood and walked to the whiteboard. "You'll come across 4 types of earnings situations," he said, drawing 4 simple charts. 1, consistently strong and growing earnings. These are companies like Coca-Cola and Apple. They show steady, predictable growth year after year. 2, wildly erratic earnings. These companies have no clear trend. One year they soar, the next they plunge. This unpredictability makes them too risky. 3, strong earnings with a temporary setback. Sometimes even great companies hit a rough patch. Maybe a new competitor emerges, or an economic downturn causes a temporary dip. If the fundamentals are still solid, these can be great opportunities. 4, consistently poor earnings. Companies that struggle year after year, barely turning a profit or posting frequent losses. These are not worth your time. Aye. Warren turned back to Michael. "Which of these 4 types should you focus on?" Michael thought for a moment. "The first one, companies with strong, growing earnings." "Correct. And what about the third one?" Michael hesitated. "Only if I can figure out why they had a setback and whether they can recover." "Bingo," Warren said with a grin. "Now you're thinking like an investor." The analyst's hat, digging deeper. "But what if a company has a bad year?" Michael asked. "How do I know if it's just a bump in the road or a sign of long-term trouble?" Warren's eyes twinkled. "That's where the real work begins. Look at the company's competitive advantages. Does it have a strong brand? Loyal customers? A durable business model? If so, it might just be a temporary problem. But if it's losing market share to competitors or struggling with fundamental business flaws, then it might be a long-term issue." Michael nodded. "So I should gather earnings data for the last 7 to 10 years, look for stability, and dig deeper if I see a recent dip?" Warren clapped him on the back. Now you're getting it. Investing isn't about guessing. It's about understanding, and it all starts with predicting earnings at a glance. Key takeaways. A company's earnings history tells a story. Look at least 7 to 10 years of data. Stable, growing earnings are ideal. Avoid companies with unpredictable earnings patterns. Temporary setbacks can be opportunities if the company has strong fundamentals. Always ask, what economic dynamics created this earnings pattern? Michael left Warren's office that day with newfound confidence. He now knew what to look for in a company's earnings and, more importantly, what to avoid. And in the world of investing, that knowledge was pure gold. The Investor's Test, Warren Buffett's secret to understanding returns. It was a crisp autumn morning in Omaha, and young Jason had finally secured the opportunity of a lifetime, a 1-hour meeting with Mr. Warren Buffett. As a budding investor, Jason had spent years reading about Buffett's methods, but now he had the chance to learn directly from the legend himself. Seated in Buffett's modest office, Jason eagerly asked, "Mr. Buffett, how do you decide if a stock is a good investment?" Buffett smiled, leaned back in his chair, and picked up a yellow notepad. "Jason, investing is like buying a farm," he began. "If you buy a farm for $1,000 and it produces $100 in profit each year, you're earning a 10% return on your investment." Jason nodded. "That made sense. Now let's apply that same thinking to stocks," Buffett continued. "Imagine a company earns $5 per share and you buy the stock for $25 per share. What's your initial rate of return?" Jason quickly calculated 5 or $25, 20%. "Exactly," Buffett said. "Most investors get lost in stock prices and charts, but I see stocks as businesses. If I own 100 shares in a company earning $5 per share, I consider that I've earned $500, whether or not the company pays me a dividend." Jason frowned. "But if you don't get paid the $500, isn't that just on paper?" Buffett chuckled. That's Wall Street's way of thinking. But here's the key. If the company reinvests that $500 wisely, its earnings and stock price will grow. Take Berkshire Hathaway. Back in the 1980s, our stock traded at $450 per share. We never paid a dividend, yet today it's worth over $75,000 per share. Why? Because we reinvested profits intelligently. Jason's eyes widened. "So you think of stocks like a bond where the yield grows over time?" "Precisely," Buffett said. "For example, in 2000, I bought shares of Yum Brands at $24 per share. The company only earned $2.77 per share that year, giving me an initial return of 11.5%, $77.24. Over time, as Yum's earnings grew, so did my effective return. It's like buying a bond that starts at 11.5% interest, but increases every year as earnings rise." Jason thought about this for a moment. "So the lower the price I pay, the higher my initial return, and the better my long-term compounding?" Buffett beamed. "You've got it. That's why price matters. Pay too much and your returns shrink, but buy at a bargain and your returns soar. That's how I turned my Washington Post investment into a 116% annual return over 28 years. Jason sat back, absorbing this wisdom. So the real test of an investment is figuring out its earnings yield and whether those earnings will grow over time. Buffett nodded. Exactly. Now go find your own great businesses at great prices. As Jason left the office, he realized that he had just been handed one of the most powerful tools in investing, an equation not just for numbers, but for wealth building. Key lessons from Buffett's investing test. 1. Think like an owner. If a company earns $5 per share and you own 100 shares, consider that you've earned $500, whether or not it's paid out as dividends. 2. Calculate your initial return. Divide a company's earnings per share by the stock price to determine what return you're effectively locking in when you buy. 3. Lower prices mean higher returns. The cheaper you buy, the better your rate of return. A $5 earnings per share stock bought at $25 gives you a 20% return. If you paid $50, it drops to 10%. 4. Compounding works wonders. Over time, if the company reinvests profits wisely, earnings grow, and so does your effective return, just like Buffett's investments in Washington Post and Berkshire Hathaway. Now, it's your turn. The next time you analyze a stock, ask yourself, what's my initial rate of return, and will it grow over time? Master this equation, and you'll be well on your way to investing success. Financial equation number 3, the per-share growth rate test. It was a crisp autumn morning when Alex, an aspiring investor, sat down at his favorite corner cafe. Sipping his coffee, he pondered a question that had been bothering him for weeks. How can I tell if a company's earnings will continue to grow over time? His mentor, Mr. Carter, a seasoned investor, smiled. Ah, Alex, you're asking the right question. The secret to building wealth in the stock market lies in a company's ability to grow its per-share earnings. Let me show you a simple yet powerful test. The power of per-share earnings growth. Mr. Carter pulled out his notebook and wrote down a simple equation. Per-share growth rate equals future earnings, present earnings, 1 year's one what? He continued. To ensure a company is effectively utilizing its retained earnings, we analyze its annual compounded growth rate over both the last 10 years and the last 5 years. This tells us whether management has been consistently delivering growth. A real-world example, Gannett Company. Alex leaned in as Mr. Carter flipped through a financial report. Let's examine Gannett, a newspaper giant. Suppose in 1990, its earnings per share were $1.18. By 2000, they had risen to $3.70. To find the annual growth rate, we input the numbers into a financial calculator. Mr. Carter took out his TIBA 35 solar calculator and walked Alex through the steps. 1. Enter $1.08 as the present value PV. 2. Enter $3.70 as the future value FV. 3. Enter 10 years as the time period N. 4. Compute the compounded annual growth rate using the calculator's function. The result? SHA 12.1% annual growth over the 10-year period. For a shorter-term view, we calculate the 5-year growth from 1995 $0.71 EPS to 2003.70 EPS. That gives us a 16.6% annual growth rate. Notice the acceleration? That's an importing the numbers. Alex furrowed his brow. So the earnings grew faster in the last 5 years than in the previous 10. What does that mean? It means we need to dig deeper, Mr. Carter explained. Was Gannett buying back shares? Expanding into profitable ventures? Experiencing a boom in ad revenue? A spike in short-term growth is great, but we need to ensure it's sustainable. Handling negative earnings. What if a company has a bad year? Alex asked. Good question. Sometimes, strong companies face temporary setbacks. Let's say a company had solid growth from 1989 to 1999, but in 2000 earnings turned negative. In such cases, we can adjust our calculation by skipping the bad year, but only if we're certain the issue is temporary and not a fundamental problem. Your turn, an investor's exercise. Mr. Carter handed Alex a challenge. Pick a company with a durable competitive advantage and compute its per-share growth rate over 10 and 5 years. This will give you a clear picture of its earning power. Key takeaways. Before leaving, Mr. Carter summarized the lesson. Management's ability to grow per-share earnings is critical to stock price appreciation. A company must wisely reinvest retained earnings to generate higher per-share earnings. Sustained growth in per-share earnings will eventually lead to higher stock valuations. Alex nodded, realizing that mastering this simple yet powerful test could help him identify truly great investments. He left the cafe, eager to put his newfound knowledge to work. Now it's your turn. Pick a stock, crunch the numbers, and discover if its growth is truly sustainable. The stock market's ultimate benchmark, Treasury bonds. Warren Buffett leaned back in his chair sipping a cherry Coke as he explained a key principle of investing to a group of eager students. Imagine, he began, that you're standing in a marketplace filled with all sorts of investments. Stocks, bonds, real estate, gold. Every single one of them is competing for your capital. But how do you decide which one offers the best deal? He let the question linger before continuing. Well, there's one investment that serves as the benchmark for all others. The U.S. Treasury bond. Safe, steady, and backed by the government, Treasury bonds are often considered the safest place to park your money. That means any investment, especially a stock, has to offer a return that's competitive with the return on treasury bonds. Otherwise, why take the extra risk? Understanding relative value. Buffett pulled out an example from his own playbook. In 2000, I was looking at H&R Block. At the time, its per-share earnings were $2.77. Treasury bonds, meanwhile, were yielding about 6%. So to compare the two, I divided $2.77 by 0.06. That gave me a relative value of 16 cents per share. The students nodded as they followed the math. This means, he explained, that if I paid 16 cents for a share of H&R Block, I'd be getting a return equal to that of a treasury bond, 6%. But here's the kicker. H&R Block was trading at just $24 per share. That meant my initial rate of return was actually 11.5 cents, nearly double the treasury bond yield. Even better, the company's earnings had been growing at an annual rate of 7.6%. Buffett leaned forward. So, tell me, would you rather own a bond yielding 6% with no growth, or a stock that starts with an 11.5% return and grows its earnings at 7.6% a year? A hand shot up. The stock, of course. Buffett grinned. Exactly. Now that doesn't mean every stock is a good deal compared to treasury bonds, but it does mean you should always make this comparison before investing. A more exciting opportunity. If H&R Block doesn't excite you, let me show you something even more compelling, Buffett continued. That same year, I bought shares in Furniture Brands International, the top manufacturer of residential furniture in America. The stock was trading at $14 per share, with earnings of $1.92 per share. That's an initial rate of return of 13.7%. But here's the real magic. Their earnings were growing at an astonishing 28% per year. The room buzzed with excitement. A 13.7% return, compounding with 28% growth? That was an investor's dream. The takeaway. Buffett paused, letting the lesson sink in. Many analysts claim that dividing per-share earnings by the treasury bond yield gives you a company's intrinsic value. That's not quite right. What you really get is the company's value relative to treasury bonds. It's a useful tool, but not the whole picture. He leaned in for his final point. One last thing. Treasury bond yields are pre-tax, while corporate earnings are post-tax. If you don't account for that, you could be making a flawed comparison. So use this method as a tool, but never rely on just one metric. What you should have learned. All investments compete for investor capital. Treasury bonds are the safest benchmark investment. A stock's return should be compared to treasury bond yields to assess relative value. If a stock offers a significantly higher return and strong earnings growth, it may be a superior investment. Buffett stood up, finishing his drink. Investing is about making smart comparisons. The better you understand relative value, the better your investment decisions will be. Now, go find your own H&R Block. The students left with a new perspective, one they would carry into their investing journeys for years to come. The Fortune Teller's Guide to Stock Growth, using per-share earnings to predict future value, the newspaper giant's hidden treasure. In the world of investing, there exists a powerful equation, one that allows us to peer into the future and estimate the value of a stock. It's not magic, but it does require discipline and logic. Let's take a journey through time with Gannett Corporation, the newspaper giant, and see how we can use historical growth rates to project the future value of a stock. The year is 1990. You're sitting in your study, poring over financial reports, wondering which stocks will make you wealthy over the next decade. Gannett catches your eye. Over the past 10 years, its per-share earnings have grown steadily from 47 cents in 1980 to $1.18 in 1990. That's a compounded annual growth rate of 9.6%. But the real question is, what will happen in the next 10 years? Step 1. Projecting future earnings. Using the historical annual growth rate of 9.6%, you punch the numbers into your financial calculator. My present value, PV equals $1.18. Growth rate I equals 9.6. Number of years N equals 10. You hit the future value FV button and voila! The projected per-share earnings for the year 2000 is $2.95. Step 2. Estimating future market price. Stock prices are often influenced by their price-to-earnings PE ratio. Over the past decade, Gannett's PE ratio ranged from 11.5 to 23, averaging 17.5. Applying this multiple to our projected earnings, projected stock price in 2000 equals $295, $551.62. Step 3. Calculating the potential return. Now, let's determine the annual compounding rate of return if you had bought a share of Gannett in 1990 at $14 and sold it in 2000 at the projected $51.62. Initial investment, PV equals $14.80, final value FE equals $51.62. Years, N equals 10. You press the CPT button, followed by the interest, I, and an annual compounding return of 13.3%. Not bad for a decade-long investment. The reality check. Fast forward to the year 2000. What actually happened? Gannett's actual per-share earnings were $3.63, exceeding our projection of $2.95. The stock traded between $53 and $70 per share, close to our estimated $51.62. If you had sold your stock at $53, your annual return would have been 13.6%. If you had held out for the peak price of $70, your return would have climbed to 16.8%. If you had invested $100,000 in 1990 at $14.80 per share, your investment would have grown to approximately $472,520 by 2000 at the higher rate. The Buffett approach, what's the real lesson here? Warren Buffett doesn't predict exact stock values. Instead, he asks a simple question. If I buy this stock today, what will my expected compounding rate of return be over the next 10 years? By comparing this rate to other investment opportunities, he determines whether a stock is worth buying. This approach allows him to ignore daily market fluctuations, focusing instead on the long-term growth of the company. Key takeaways. Past growth can help project future stock prices, but it's not an exact science. Buffett doesn't calculate a stock's exact value. Instead, he estimates its future return potential. The right question isn't, what is the stock worth today, but rather, what return can I expect over time? By thinking long-term, investors can ignore short-term market noise and stay focused on true business value. In investing, knowledge compounds just like money. Now that you know how to project future stock values, what company will you analyze next? The Power of High Returns on Equity, a lesson from Warren Buffett. A story of two companies, understanding Buffett's investment mindset. Imagine you have two friends, John and Sarah. Both are successful business owners, but their companies operate very differently. One day, they both approach you with an investment opportunity. John's company, Alpha Inc., consistently earns a 33% return on shareholders' equity. This means that for every dollar of equity in the company, the business generates 33 cents in profit each year. Sarah's company, Beta Corp, earns a return of only 8% on equity, meaning each dollar of equity generates just 8 cents in profit. If you were to invest your money, which company would you choose? Warren Buffett would pick John's Alpha Inc. every time. But why? Thinking like Buffett, stocks as equity bonds. To Buffett, a share of stock is like an equity bond, where the per-share earnings represent the bond's yield. Unlike traditional bonds, which offer fixed interest payments, an equity bond's yield can fluctuate based on the company's performance. This means that if a company consistently earns high returns on equity, the investment can compound at an impressive rate over time. Let's break this down further with a simple real estate analogy. The real estate analogy: your house as an investment. Imagine you buy a rental property for $200,000. You put down $50,000 of your own money, your equity, and borrow the rest from the bank. After all expenses, including mortgage payments, you make a net rental income of $5,000 per year. Your return on equity would be. Now imagine another rental property with the same purchase price, but after expenses, it only generates $2,000 per year. The return on equity would be just 4%. Would you rather own the property generating a 10% return or the one earning only 4%? The answer is obvious. You want the higher return. This same principle applies when investing in businesses. Companies that generate higher returns on shareholders' equity create wealth at a much faster rate than those with lower returns. The case of Company A versus Company B. Let's take this a step further. Suppose Company A and Company B each have the same capital structure. $10 million in assets, $4 million as in liabilities, $6 million in shareholders' equity. However, Company A earns $1.98 million per year, a 33% return on equity, while Company B earns only $480,000 per year, an 8% return on equity. If you could invest in just one, you'd logically choose Company A because it generates wealth much faster than Company B. But what happens if both companies retain their earnings and reinvest them at their respective rates of return? Company A, over 10 years, its equity grows from $6 million to over $103 million, and its earnings soar to $34 million per year. Company B, over 10 years, its equity grows to just $12.95 million, with annual earnings of only $1 million. The difference is staggering. Company A's ability to reinvest at 33% per year causes wealth to compound rapidly, while Company B grows at a much slower pace. The magic of compounding return. Buffett understands that the real power of investing lies in compounding. By consistently reinvesting earnings in businesses with high returns on equity, wealth grows exponentially. Let's say you had $6 million to invest. Should you buy 100% of Company B or just 25% of Company A? Buffett would take 25% of Company A because even with a smaller stake, the compounding effect would make it far more valuable over time. Why Buffett pays a premium for quality businesses. Now imagine someone offers to sell you Company A for $24.75 million, 4 times its equity value. That seems expensive, right? Not necessarily. If Company A continues to compound at 33% annually, in 10 years its equity will be worth over $100 million, making your original investment a phenomenal bargain. Even if you paid 30 times earnings, $59.4 million, your return over 10 years would still be 21.8% annually, a return most investors can only dream about. The real-life example, Bristol-Myers Squibb. In 1993, Bristol-Myers Squibb had a 35% return on equity and a durable competitive advantage. Buffett saw the opportunity and bought nearly 1 million shares. Over the next 8 years, an investor in Bristol-Myers Squibb would have earned a 24% annual return, proving that companies with high returns on equity and strong competitive positions make excellent long-term investments. Key takeaways from Buffett's strategy. Stocks are like equity bonds, with per-share earnings acting as the bond's yield. High return on equity is a key indicator of a company's ability to compound wealth. The power of compounding magnifies wealth creation in businesses with durable competitive advantages. Paying a higher multiple for a great business is often worth it if the company can sustain high returns on equity. By focusing on companies with consistently high returns on equity, Buffett has built one of the greatest investment records in history. The next time you analyze a stock, ask yourself, is this a Company A or a Company B? Your long-term wealth may depend on the answer. The Art of Predicting Returns, Warren Buffett's secret formula. Warren sat in his office, flipping through the latest market reports. The phone rang, another investor seeking advice on whether to buy a stock that had recently taken a nosedive due to bad news. Warren smiled. He had seen this pattern countless times before. The key, he thought, wasn't in the noise of the market, but in the numbers. The cold, hard math that revealed whether an investment was truly a bargain or a trap. He had a formula, a tried-and-true method for determining whether a stock was worth his attention. It all boiled down to one critical number, the projected annual compounding rate of return. If the stock's potential return was high enough, he bought in. If not, he moved on. Simple? Yes. Easy? Not quite. Why this number matters? To Warren, investing was not about excitement or following trends. It was about predictability. The best investments were those where he could reasonably estimate the business's future earnings. This predictability stemmed from the company's earning power, its ability to generate profits year after year. But how do you measure this earning power? That's where the projected annual compounding rate of return came in. To understand the method, let's take a step back in history. The theory behind the numbers. Warren's approach was heavily influenced by John Burr Williams, who defined the intrinsic value of a business as the sum of all its future earnings discounted back to present value using a treasury bond rate. This was a logical way to assess a company's worth. If you could estimate its earnings over time, you could determine how much you should pay for it today. Of course, there was a problem. Estimating earnings over the next 50 or 100 years was nearly impossible. The world changed too quickly. The television industry was a great example. Monopolies in the 1960s had transformed into a fiercely competitive field by the 2000s, with cable and the internet slicing up ad revenue. Even the greatest businesses could be disrupted. Benjamin Graham, Warren's mentor, warned against blind faith in future earnings. He noted that an ever-growing earnings stream could create insane valuations. To address this, analysts often divided the future into two periods, one with high growth and one with lower growth. But even then, the valuation depended heavily on the discount rate used. The practical approach, a 10-year projection. Warren took a simpler, more practical route. Instead of looking 50 years ahead, he focused on projecting a company's equity value per share over the next 10 years. Here's how he did it. 1. Determine the return on equity. Look at historical trends to see how efficiently the company reinvests earnings. 2. Subtract the dividend payout rate. Since dividends reduce reinvested earnings, they must be accounted for. 3. Project the future equity value. Use the adjusted ROE to estimate the company's per-share value 10 years from now. 4. Calculate future earnings. Multiply the projected equity value by the expected ROE in year 10. 5. Estimate the future stock price. Based on expected market valuations, determine where the stock might trade. 6. Compare the projected return to alternative investments. If the expected return beats other options and inflation, it's a buy. Case study. Berkshire Hathaway, 1986 to 2000. Let's step into Warren's shoes in 1986 and run the numbers on his own company, Berkshire Hathaway. Starting equity per share, 1986, $2,073. Historical ROE, 1964 to 1986, 23.3% compounded annually. Using a financial calculator, the projected equity value in 2000 would be $38,911 per share. Now the key question. How much should you have paid in 1986 to earn at least 15% annually? Using discounting calculations, the maximum buy price for a 15% return, $5,499 per share. The actual market price in 1986, $2,700 per share. That meant a potential return of 20.9% annually if held until 2000. What actually happened? Berkshire's real equity per share in 2000, $40,442. Stock price ranged from $4,800 to $71,300. Annual return from $2,700 in 1986 to $71,300 in 2000, 26.39%. The takeaway: price determines return. The most important lesson here is simple. The lower the price you pay, the higher your return. Paying too much, even for a great company, can cripple your returns. For example, if you had bought Berkshire at its peak of $71,300 in 2000, your projected return for the next decade, assuming a 23.6% growth rate, would only be 16.7%. Not bad, but significantly lower than the 26.39% achieved by those who bought cheap. The golden rule? Pay less, get more. Pay more, get less. What you should have learned: one cannot accurately discount earnings far into the future. The world changes too much. 2. You can, however, reasonably estimate earnings 10 years ahead. This is a practical and useful approach. 3. Price dictates return. The lower the price you pay relative to future value, the higher your compounded return. Warren never relied on market hype. He relied on numbers. Stood that the market was like a pendulum swinging between greed and fear. When fear drove prices down, his formula told him whether the opportunity was real. And when the numbers lined up, he didn't hesitate. He wrote the check. Would you? The story of financial equation number 8, the power of projections. In the world of investing, making projections is like planting seeds. With the right calculations, foresight, and discipline, you can reap the fruits of your investments. Let's step into a story, a lesson in how Warren Buffett used the art and science of projections to evaluate Bristol-Myers Squibb in 1993, setting an example for how you too can harness these tools. The scene: 1993 and the Bristol-Myers Squibb opportunity. It's 1993. Warren Buffett, sitting at his Berkshire Hathaway desk, is reviewing the financials of Bristol-Myers Squibb. The company has been a steady performer with a strong competitive advantage. Warren, using his famous equity as a bond approach, views each share of Bristol-Myers Squibb as a bond with an attached coupon in the form of earnings and dividends. At $13 a share, he makes an investment of 12.4,957,200 shares of the company. Why? Let's break it down. Shareholder equity per share, $2.90, earnings per share, EPS, return on equity ROE, 37.9%. This means every dollar of equity is earning a whopping 37.9%. Of this, 35% is retained by the company to grow its equity base, while 65% is paid out to shareholders as dividends. The power of projections. Warren's plan involves projecting where Bristol-Myers Squibb's financials could be in 10 years. He starts by calculating the future equity value per share and the future earnings per share, EPS. Here's the step-by-step logic. Step 1. Calculating equity growth. The retained 37.9% ROE equals an annual compounding growth rate of 13.25% in equity per share. Starting with $2.90 in 1993, the equity grows annually. Text future equity, text current equity, times 1 plus 0.1325 N. By 2003, the equity per share grows to $10.60, calculating future earnings. Future earnings per share are tied to ROE. Multiplying the equity value each year by 37.9%, Warren projects the earnings for 2003 to be 3.81 cents per share. Step 3. Estimating stock price. Using a conservative price-to-earnings P/E ratio of 18, Warren estimates the stock price in 2003. Text stock price equals earnings per share, text P/E ratio equals 3.81 times 18, 8.58. There's 957,200 shares. This amounts to a projected market value of $65.645 million. The total return. To calculate his total returns by 2003, Warren includes both dividends and capital gains. 1. Dividends. Over 10 years, the dividend payouts sum to $15,104 million. 2. Capital gains. Selling his shares at $68.58 each generates $65.645 million. Adding these together, Warren's total proceeds reach $80.76 million. Starting with a $12.4 million investment, this represents an annual compounding rate of return of 20.5%. Reality check. Accuracy of projections. By comparing projections to actual results, Warren ensures his methods hold water. From 1993 to 2001, his margin of error in projecting earnings ranged between 8% and 32%. Remarkably, in 2001, the stock traded between $50 and $70, closely aligned with his projections. Key lessons from Warren's success. 1. Projections can be reliable. If a company has a durable competitive advantage and consistently high ROE, long-term projections are often accurate. 2. The role of P/E ratios. Always use the average P/E ratio of the past 10 years for realistic stock price estimates. Avoid relying on historically high P/E ratios. 3. Stay within a decade. Projections beyond 10 years become highly uncertain. Stick to a manageable horizon. 4. The right price matters. Even the best projections can't save an investor who overpays for a stock. Paying a fair price is the foundation of profitable investing. Measure the moral of the story. Warren Buffett's investment in Bristol-Myers Squibb teaches us that wealth in the stock market isn't built on speculation, but on calculated foresight. By understanding the mechanics of equity growth, earnings, and valuation, you can predict an investment's potential. Like Warren, let your seeds of investment grow into a bountiful harvest, but always plant them at the right price. Now take out your calculator and try your hand at projecting the future. Who knows? Your next investment might just be the seed that grows into a fortune. Thinking like Warren, the H&R Block case study. Warren Buffett's investment philosophy has always been guided by a set of principles that reflect deep understanding, discipline, and patience. Let's delve into the case of H&R Block, the tax preparation giant, through Warren's lens. This story serves as both a narrative and a guide for those seeking to invest the way Warren does. The origins of an opportunity. In the late 1990s, the financial world was still reeling from the dot-com bubble. While many investors chased fleeting technology trends, Warren turned his gaze to the enduring brick-and-mortar business of H&R Block. Known as the largest income tax preparer in America, H&R Block's reputation for reliability and its robust brand recognition caught Warren's attention. Imagine Warren in his study, leafing through Value Line, the publication he often uses to identify promising businesses. Among the numbers and summaries, H&R Block stood out, not because it was flashy or revolutionary, but because it was consistent. He'd followed the company for years, watching it grow, adapt, and maintain its dominance in the tax preparation market. Why H&R Block? Breaking it down. When Warren evaluates a business, he seeks answers to a series of key questions. Let's examine how H&R Block stood up to these criteria. 1. Does it have a durable competitive advantage? H&R Block is synonymous with tax preparation. Competing with a business so deeply entrenched in its industry would require astronomical sums to overcome its brand equity and network of offices. This moat around its business delighted Warren as it signified long-term dominance. 2. Is the business understandable? Taxes are a universal burden, and H&R Block's service, simplifying this burden, resonates with millions. The business model is straightforward. People need help with taxes, and H&R Block provides it. This simplicity is a hallmark of businesses Warren loves. 3. Is it conservatively financed? In 2000, H&R Block had long-term debt of $872 million, but generated $251 million in earnings. Warren liked that it could theoretically pay off its debt in just a few years, showcasing financial prudence. 4. Do earnings show consistent growth? From 1989 to 1999, H&R Block's earnings per share grew at a compounded annual rate of 8.2%. Such steady performance, even amid occasional hiccups, underscored the company's resilience. 5. Does the company allocate capital wisely? H&R Block reinvested in strategic areas like financial services and tax software, while also buying back 9 million shares over a decade. To Warren, these moves demonstrated that management knew how to enhance shareholder value. The price matters. Warren's valuation process. For Warren, even the best business must be purchased at the right price. He uses a simple but powerful formula. Compare the initial rate of return from the company's earnings to the return on government bonds. In 1999, H&R Block earned $2.56 per share. The government bond yield that year was around 6%. Dividing $2.56 by 6% gave a relative value of $42.67 per share. However, H&R Block stock was trading around $28 and $29 per share, significantly below this value. To Warren, this was a bargain. By purchasing at this price, Warren effectively locked in an initial return of about 9%, with the added bonus of earnings growth projected to 8.2% annually. Compared to the static 6% yield of bonds, H&R Block stock was a compelling choice. Lessons from H&R Block. Warren's investment in H&R Block underscores several critical lessons for investors. 1. Look for businesses with moats. The harder it is for competitors to enter a market, the safer your investment. 2. Understand what you own. Complexity is often a red flag. If you can't explain a business in a few sentences, think twice about investing. 3. Buy at the right price. Even great businesses can become poor investments if you overpay. Be patient and let the market come to you. 4. Focus on long-term returns. Don't be swayed by short-term market movements. Consistent earnings and high returns on equity are indicators of lasting value. The takeaway. Warren's purchase of H&R Block in 2000 wasn't just about buying a stock. It was about buying into a business he understood, trusted, and believed would stand the test of time. By following his methodical approach, any investor can learn to see the market as Warren does. Not as a casino, but as a place to buy pieces of wonderful businesses at sensible prices. The Tale of the Equity Bond. Lessons from H&R Block. Once upon a time in the world of investing, there was a company called H&R Block. Known for its tax preparation services, the company held a certain charm for those who could see beyond the surface numbers. It wasn't just a stock. For the shrewd investor, it behaved much like a bond with a growing coupon. Let's dive into how this worked, step by step, in a teaching story inspired by Warren Buffett's methods. The beginning of the journey. Understanding the price. In 1999, H&R Block stock was trading at $12.88 per share. For those who looked closer, the company had an average annual return on equity, ROE, of 22%. This meant it was highly efficient at using its shareholders' money to generate profit. But here's the real magic. The company was retaining about 40% of its earnings to reinvest in its business. How does this work out over time? Retaining 40% of a 22% ROE means the equity could grow at 8.8% annually, 40% of 22%. With this, the equity value of $12.88 was projected to grow to about $29 in 10 years by 2009. The Texas Instruments lesson. Now, let's grab a trusty Texas Instruments BA35 solar calculator to confirm. Punch in PV, present value, $12.88, N, years, 10. Interest rate I, 8.8%. Hit CPT and FV, future value, and voila, the future equity value appears as $29.93. Hash. The stock as a bond, predicting future earnings. Fast forward to 2009. If H&R Block maintained its stellar 22, then with an equity value of $29.93, it could generate earnings per share EP 22%, 29.93 equals 6.58. Here's where the equity bond idea shines. If H&R Block stock traded at its average price-to-earning ratio of 22, its market price would be, market price equals 6.58 times 22, 144.6. For someone who bought the stock at $29 in 1999, selling it for $144.76 in 2009 would result in an annual compounding return of approximately 17.4% before accounting for dividends. Comparing another method. But what if you prefer to focus on earnings growth rather than equity value? Over the previous decade, H&R Block's earnings grew at an average of 8.2% annually. If this trend continued, earnings would rise from $1.61 per share in 1999 to $5.65 in 2009. Using the same average PE of 22, market price equals 5.65 times 22 equals 124.3. In this scenario, the return would be slightly lower, around 15.6% annually. Warren's bond-like perspective. Now let's summarize what Warren might see in this investment. 1. Initial yield. With a ROE of 22% and a retention rate of 40%, the reinvested earnings alone provided a bond-like yield of 9%. 2. Growth in coupon. With earnings projected to grow at 8.2% annually, the coupon earnings increases over time. 3. Overall return. Over 10 years, the investment promised a return between 15.6% and 17.4% annually, depending on the growth assumptions. A bonus surprise. Though the plan assumed a patient 10-year hold, the market sometimes rewards great businesses sooner. By mid-2001, H&R Block's stock price had already soared to 60 to return 107% in just over a year. The lesson. This story teaches us that investing in businesses with durable competitive advantages and strong ROEs can yield extraordinary results. By treating stocks as equity bonds, we can focus on their ability to grow earnings and equity over time. But the magic lies in patience and understanding. Sometimes the market surprises you, as it did for H&R Block investors. When you own a piece of a great business, you don't always have to wait 10 years to see significant returns. The story of La-Z-Boy as an equity bond, a lesson in compound growth. Imagine you are a savvy investor in the year 2000, with a keen interest in finding the next golden opportunity. You come across La-Z-Boy, a well-known name in furniture, and begin your analysis, inspired by Warren Buffett's philosophy of treating stocks like equity bonds. Let's walk through this step by step in story form to uncover its investment potential. The initial observation, a modest beginning. At the start of 2000, La-Z-Boy's stock traded at 9.80 cents per share. While it might not seem like much, you notice the company has a 12.8% return on equity, a sign of a durable competitive advantage. Moreover, La-Z-Boy has been retaining approximately 71% of its earnings over the years, reinvesting them into the business to fuel growth. Using these figures, you project the company's equity value. If the equity grows annually at 9.1%, 71 of 12.8%, the share value should rise to approximately $23.41 by 2010. You confirm this on your trusty Texas Instruments B8035 Solica. Present value PV, $9.80 of interest, I, 9.1%, number of years N10, future value FV, $23.41, projecting earnings and market price. If La-Z-Boy's equity value reaches and the company continues earning 12.8% ROE, 8% ROE, its earnings per share in 2010 should be EBITDA in 0.99. At its historical average price-to-earning ratio of 15, La-Z-Boy's market price would then be market price equals 2.99 times 15 equals 44.8. Now consider if you had purchased La-Z-Boy for $14 per share in 2000. Selling it for $44.25 in 2010 would give you a pre-tax annual compound return of approximately 12.34%. Add in dividends over the decade and your return only gets sweeter. An alternate scenario? The power of growth. Let's say you instead project La-Z-Boy's future using its historical earnings growth rate of 14.1% per year. By 2010, its EPS would grow to text EPS in 2010 times 1.141 10 equals 6.2. At the same P ratio of 15, La-Z-Boy's market price would then be text market price 6.10 equal 90.3 real. If you paid $14 per share in 2000, this projection would yield a 20% annual compounding return. Once again, your calculator verifies the math. PV $14, FV $90.30, NN 10, I 20%. Warren Buffett often describes stocks with a durable competitive advantage as equity bonds. Viewing La-Z-Boy this way, you might say it offered 1. A yield of 11.5%, based on its ROE and price. 2. A growing coupon of 14.1 cent, thanks to its earnings growth rate. By 2010, your initial $14 investment would have grown to somewhere between 44 and 85 and 80 cents, yielding an annual return of 12.34% to 20 cent. And that's without factoring in dividends. A surprise upside. Fast forward to December 2001. La-Z-Boy's stock is already trading at $22 per share, delivering a stunning 35% annual return in just 1.5 years. This highlights a key lesson. Companies with a durable competitive advantage often surprise you with their performance, rewarding patience and conviction. Key takeaways. 1. Think like an owner. Treat stocks as equity bonds with growing coupons. Focus on their return on equity, earnings retention, and growth prospects. 2. Be conservative yet optimistic. Use historical averages to project future growth, but remain open to pleasant surprises. 3. Durable competitive advantage is key. Companies like La-Z-Boy and Gannett succeed because of their ability to earn consistent above-average returns on equity while reinvesting wisely. 4. Compound interest is a wealth builder. Small annual gains, compounded over time, can lead to exponential growth in wealth. When you approach investing with a mix of analysis, foresight, and Buffett-like patience, the results often speak for themselves. As La-Z-Boy's story shows, success isn't just about numbers. It's about understanding and trusting in the power of great businesses. Gannett stock, the tale of an equity bond. In the summer of 1994, Warren, a seasoned investor with a knack for seeing the future in numbers, sat in his office with a cup of black coffee and a calculator. He had been analyzing Gannett, a leading media company, and something intriguing caught his eye. To Warren, investing wasn't just buying stock, it was buying a stream of future returns, and Gannett stock had the makings of a prized equity bond. The equity bond concept. Think of this stock like a bond, Warren mused. It has a yield, its return on equity, And that yield grows over time like a bond whose coupon payments increase each year. Here's what Warren saw. In 1994, Gannett's per-share equity value was $6.52, and its return on equity was a stellar 20.4%. Historically, the company retained 60% of its earnings to reinvest in growth. That meant 12.24% of the return. 60% of 20.4% was being compounded annually into the equity value. With his trusty calculator, Warren punched in the numbers. Present value PV, $6.52, growth rate I, 12.24%, time period N, 10 years, the result. By 2004, the per-share equity value was projected to grow to $20.68. That was the foundation of Warren's equity bond, projecting the future earnings. If Gannett can keep earning a 20.4% return on equity, Warren thought, then by 2004, with an equity value of $20.68, the company should produce earnings of $4.22 per share, 20.68 by 20.4%. From there, he considered the potential market price. Using Gannett's historical price-to-earnings P/E ratio range of 15 to 23, Warren calculated that's low market price, $4.22, 63. High market price, $4.20 twice 23, $97.06. Adding in projected dividends of $11.92 per share over 10 years, Warren estimated that Gannett's total return would range from 11.87% to 16.09% annually, depending on the P/E ratio in 2004. Freddie Mac, a different equity bond. A few years earlier, in 1992, Warren had applied similar reasoning to the Federal Home Loan Mortgage Corporation, known as Freddie Mac. The company operated in a niche that Warren understood well, securitized mortgages. It was a quasi-monopoly in its field, supported by its government-sponsored status. Freddie Mac's financials were impressive. Earnings had grown at an annual rate of 17.6% from 1986 to 1992. Return on equity averaged 22.3%, far above the corporate norm of 12%. Warren paid $9.67 per share for Freddie Mac, which translated to initial yield of 8.5%, based on earnings of $0.82 per share. More importantly, this yield wasn't static. Earnings, and thus the coupon payments of this equity bond, were growing at 17.6% annually. The power of compounding returns. As Warren reflected on both Gannett and Freddie Mac, he thought about the power of compounding. If I buy Gannett today for $24.40 per share and hold it for 10 years, I could expect it to be worth between $66.62 and $96.54 with dividends included, he calculated. That meant an annual return of 10.55% to 14.72%, depending on future market conditions. Similarly, Freddie Mac, purchased at $9.67 per share, offered both a higher initial yield than bonds and a growth rate that far outpaced inflation. Over time, these characteristics compounded into massive returns. The moral of the story. Warren's approach teaches us 3 timeless lessons. 1. Think like a bondholder. Every stock is an equity bond with a yield, return on equity, and a growth rate, reinvestment rate. Evaluate it as such. 2. Trust compounding. Small annual growth rates like 12.24% can transform modest investments into sizable fortunes over time. 3. Buy quality at the right price. Companies with strong, predictable earnings, durable advantages, and reinvestment opportunities are worth their weight in gold, but only if purchased at the right price. When Warren bought Gannett and Freddie Mac, he wasn't just investing in companies, he was investing in streams of future returns. And as history shows, his calculations weren't just math, they were the blueprint for extraordinary wealth. Freddie Mac stock, an equity bond lesson with Warren Buffett. Once upon a time in the world of finance, an investor named Warren Buffett looked at Freddie Mac, the Federal Home Loan Mortgage Corporation, as an intriguing opportunity. To many, Freddie Mac's stock appeared to be just that, a stock. But Warren, ever the keen-eyed investor, saw something more. He saw a hybrid between an equity and a bond. Hack the equity bond perspective. Imagine buying a bond that offers a stable interest rate, except this bond also has the potential to grow its payout year after year. That's how Warren viewed Freddie Mac. In 1992, Freddie Mac stocks was $9.67 a share. Its return on equity had been stellar, averaging 22.3% over the previous 7 years. Equally impressive, the company retained 72% of those earnings, reinvesting them back into the business. Warren reasoned that if Freddie Mac could maintain this track record, the equity value per share would grow significantly. Based on calculations, the equity value per share, $4.92 in 1992, was projected to grow to $21.79 by 2002. With the same 22.3% ROE, this would mean earnings of $4.86 per share by 2002. What about the market price? If Freddie Mac stock traded at its historical low price-to-earnings PE ratio of 9, this would place its market price at 43.34 cents per share, $4.86 by 9. At its historical high PE of 12.8, the price could reach 62.20 per share. Adding in the expected dividend pool of approximately $7.61 over the decade, Warren estimated that his total pre-tax return would range between $51.35 and $69.81 per share. The power of compounding. Let's break this down as Warren did. If his $9.67 investment per share grew to $69.81, including dividends, that meant an annual pre-tax compounding return of between 18.17% and 21.85%. After accounting for taxes, the annual return would still be an impressive 14.82% to 17.92%. This type of compounding return demonstrated the beauty of investing in a business with a durable competitive advantage and strong growth prospects. Alternative projections, using earnings growth. Warren also considered another approach, projecting Freddie Mac's performance using its historical annual earnings growth rate of 17.6%. If this growth continued, Freddie Mac's per-share earnings would rise to $4.14 by 2002. At a PE of 9, this suggested a market price of $37.26 per share. At a PE of 12.8, the price could climb to $52.99. Adding dividends to this equation brought total returns to between $43.43 and $59 per share, equating to annual compounding returns of 16.2% to 19.8%. Hash the outcome. Fast forward to 2000. Warren's conservative projections proved to be quite accurate and even a bit modest. Freddie Mac's stock traded between $37 and $66 per share, delivering Warren a pre-tax annual compounding return of 18 to 27%, excluding dividends. But then Warren did something unexpected. He sold his shares. Why? Freddie Mac's business model had shifted, and with it came new risks. Warren believed that highly leveraged businesses like Freddie Mac could face catastrophic consequences if something went wrong. The takeaway: lessons from Warren. Warren's journey with Freddie Mac offers timeless lessons for investors. 1. Think of stocks as businesses, not just tickers. When Warren analyzed Freddie Mac, he saw its stock as a growing equity bond hybrid, not just a price on a screen. 2. Conservative projections are key. Even though his estimates were conservative, they gave him a margin of safety. 3. Know when to exit. When Freddie Mac's risk profile changed, Warren exited to protect his gains. His famous rule? Rule number 1, don't lose money. Rule number 2, don't forget rule number 1. 4. Leverage is a double-edged sword. Companies with high leverage can grow quickly, but they're also vulnerable to rapid decline. In the end, Warren's Freddie Mac story isn't just about numbers. It's about understanding the dynamics of a business, sticking to fundamental principles, and knowing when to step away to protect your wealth.